I'm Andy Agathangelo, the founder of the Transparency Task Force. I'm going to be hosting this evening's session, which, as you all know, is about how Irish SMEs were victimised by the Banks and Regulator. I think it's fair to say that the Transparency Task Force has run several hundred events, and I genuinely believe the event we're going to be participating in tonight is quite probably the single most important event that we've ever run. Many of tonight's attendees are brand new to the Transparency Task Force, so I'm going to be taking you through a few slides to tell you a bit about us, but also to sort of set the scene nicely for the next couple of hours or so. So, the Transparency Task Force is a certified social enterprise, and our mission is to fix the financial sector through reforming the regulatory framework that's supposed to govern it. That phrase, supposed to govern it, is quite telling. We genuinely believe that the financial industry would be working a lot better and serving society a lot more effectively if we had a regulatory framework that was effective. Speaking very frankly with you all, when I started the Transparency Task Force in 2015, I really did think that the regulatory framework was a big part of the solution to the many problems that I could see in the financial industry, having worked in it since the age of 22. But over the years, to be blunt, I've come to the conclusion that in actual fact, the regulatory framework that we currently have is a great big part of the problem. And if you're in any doubt about that right now, my hunch is that by the end of tonight's session, you won't be. We have a strategy for driving change, and this strategy for driving change is remarkably important. We are about making a difference. We are about making real change happen. If we weren't, we would just be a nice talking shop. But the Transparency Task Force works very hard to make real change happen. And our strategy for driving change is to bring together the thinking of two groups of people. First of all, those like most of us who have a sense of passion and purpose about the changes that we want to see. And the second group, those individuals who have the power and the position to make change possible. And using the very little resource that we have, we dream up all sorts of ways to bring those two groups together. And frankly, to give us a chance to influence the people who have the influence and power over those who make the rules. That's our strategy for driving change. It's proven to be quite effective. I could point to many things. The two things that I'm probably most proud of are the two parliamentary inquiries we've had opened. And I'm saying this for a particular reason, which will become clear later. First of all, we had an inquiry opened about the need for greater transparency on costs and charges in pensions. And we also had an inquiry opened in the UK Parliament about the topic of the need for pension scams, legislation and regulation to be significantly changed. I could point to many other things, but I'm just emphasizing the idea that we have a strategy for driving change. We aren't just a talking shop, we're here to make a real difference. And again, speaking very openly and frankly from the heart, the more I learn about the carnage caused by catastrophic regulatory failure, the more motivated I am as an individual to carry on working hard to make a difference. Our guiding principle is a few words, first used by the American Justice Louis Brandeis in his 1914 book. In that book, he first quoted the term, "Sunlight is the best disinfectant." It's a very powerful phrase, sunlight is the best disinfectant. And that takes us to the question, well, what is it that needs disinfecting? And I'm going to attempt to share my screen and show you something called Violation Tracker UK. I could talk about this at length, but I won't. But I'm just going to draw your attention to a few bits of data. Data is important, folks. The Transparency Task Force is very much a data-led and evidence-led organisation. In Violation Tracker UK, one of the searches you can do is to list all of the industries ranked by the total amount of fines since the year 2010. There are many, many reasons, ladies and gentlemen, why the financial sector, which if you think about it, has to be trustworthy to function. The word credit comes from the Latin word credere, which means to believe in. If you think about it, if you take trust and confidence out of the financial industry, there is simply nothing left. So for all these reasons, you would imagine that the financial sector would defend its reputation ruthlessly. It would be hyper vigilant against any individual organization that was in some way misbehaving and jeopardizing the reputation and integrity of the sector. But the data tells us something quite different. Not only is the financial sector not one of the best when it comes to trustworthiness, it's actually the worst. Here we've got this list. There's about 50 or so industries in this list. You can see the top 20 or so. You can see, ladies and gentlemen, that the financial services sector, despite the fact that it has to be trusted to function successfully, I'm repeating myself, I know, it's been fined over £5 billion since the year 2010. But it gets worse than that, because if you look at the second worst offending industry, aerospace and military contracting, they've been fined only, in inverted commas, £1.5 billion. So not only is financial services the top, it's the top by a horrifically long way. This clearly points to something going wrong in the way the financial sector is operating. And it gets worse still. If you click on financial services, as I'm doing now, first of all, you'll see the worst 10 organizations: NatWest, Barclays, Lloyds, UBS, JP Morgan Chase, Deutsche Bank, Credit Suisse, HSBC, Citigroup, Glencore. They are the worst offenders. But when you scroll down this list, you're given a ranking of all the individual cases ranked by how bad they are. So Credit Suisse in 2021 were fined for banking violations to the tune of £292+ million. How much wrong do you have to do to be fined at £292 million? The mind boggles. But when you scroll down the list, you start to see a pattern. And the pattern you see is this: the same organizations are being caught doing the same things over and over again. Quite literally, the same organizations being caught doing the same things over and over again. And this makes me very worried for two reasons. First of all, it really does suggest that these organizations, largely banks, are seeing the idea of doing something wrong, probably making an absolute fortune while they're doing it in terms of bonuses and profit, etc. Doing something wrong, getting caught, being fined. They're starting to see it, perhaps, the data would suggest, as a cost of doing business. Now, that's a real worry because it points to toxic culture. The second reason why I'm very worried about what this data is showing us all is because the central purpose of a financial regulator is to get the market behaving properly. Surely, ladies and gentlemen, the fact that the trust-dependent industry of financial services, surely the fact that it's the most violating of all the industries in the UK, surely that points to a problem. And isn't it the case, I propose, that the process of catching, let's say, a bank doing something wrong, fining the innocent shareholders, you and us, pension savers, investors, we're the people being fined, the innocent shareholders, surely that process is proven to be ineffective. And then you might say to yourself, well, this is crazy because we had a global financial crisis not that long ago. And the central learning from the global financial crisis, as far as the regulatory world was concerned, is very simply that there needed to be much, much greater personal accountability. So they created the senior manager certification regime. I believe I'm right in saying, despite all the violations I've just shown you, hundreds of them, the senior manager certification regime has been used twice. Once was about 3 weeks ago when the chap who was responsible for TSB's IT collapse got into trouble. So there's a bit of a disconnect, isn't there? An industry that needs to be trusted, behaving very, very egregiously and not being sorted out by the regulators. Does this not, ladies and gentlemen, point to some kind of chronic and catastrophic regulatory failure? I do believe that's what it's pointing to. That's my personal belief. And you may think the same now. You may think the same by the end of tonight's session. Now, I'm setting the scene in this way for a very deliberate reason. We're going to be making some pretty potent points tonight, and I'm keen for you to feel free to challenge it, but it's all going to be evidence-based. It's all going to be evidence-based. The slides I'm going through and all the other slides you see today will be circulated. We are happy to stand behind everything that we are saying. We have several objectives. I'm only going to talk about the first three now. The others we'll be covering later. Objective number one is to show that there has been, emphasize, has been a widespread banking fraud. Number two, there has been a catastrophic regulatory failure, and there has been a cover-up. Happy to make it as plain and simple as that. Who are you? Who are attendees tonight? We've got a range of subject matter experts who I'm so pleased to step forward to speak out tonight. We have journalists, we have politicians and former parliamentarians, we have lawyers, we have financial advisors, we've got leaders of pro-consumer campaign groups, anti-corruption campaigners, we've got leaders from the church, we've got, I think, somebody here from the Central Bank of Ireland, which is interesting. But we've also got survivors, I'm using that word deliberately, survivors of malpractice, malfeasance, misconduct, mis-selling, and outright fraud by banks and other financial institutions. And we've also got whistleblowers. That's who you are. And I'm very, very proud that you're here. What you're looking at right now, ladies and gentlemen, is one of the publications we produced, our Faces of Financial Crime publication. I'm mentioning it for a few specific reasons. We produced this in the summer of last year. We launched it in Parliament, and it's basically a couple of hundred pages talking primarily about the life experiences of 22 innocent victims of financial crime. And again, I'm going to share my my screen here on Zoom, because there's a couple of bits I want to make direct reference to, because it really does speak precisely to what we are talking about today. The booklet, Faces of Financial Crime, as I mentioned, talks about 22 case studies. There are lots of pictures at the front and there are lots of pictures at the back. I know through the hundreds of conversations I've had with victims of financial crime and scamming and fraud by the banks and others, that those of you who have been through that kind of experience will relate to the pictures you're looking at right now. That the front of the document has got images that relate to what it's like to be a victim of financial crime. Absolutely horrific. I don't want to get too depressing about this, but in March, I went to the first funeral I've been to of a suicide victim, somebody who lost his entire life savings as a direct consequence of having been ripped off by scammers and financial criminals, and badly, really badly let down by the regulators. So these images tell a story. They talk about the human cost and suffering of what matters, of what happens to people when they become the victims of financial crime. including, of course, the hundreds, thousands of individuals who are victims of financial crime by the banks. At the back of the publication, we've got a few more pages of pictures. These pictures aren't about the victims. These pictures are about the criminals. And there are two types of pictures. The one on the top left, as I'm seeing it, is a crook, a criminal, a guy with a mask. It's obviously a representation of the criminal. That's the kind of picture you'd think of when you're thinking about some kind of financial crime, criminal or scammer. But look at the picture on the other side of the page. To my mind, that picture represents educated, suited executives in a financial institution, let's say a bank, who are making policy decisions that are leading to malpractice, malfeasance, misconduct, crime, fraud. It is genuinely shocking to me at the age of 59 that in the last few years of my life, I have come to realize that there has been a widespread collapse in the trust and confidence of the establishment and all of the institutional pillars that once upon a time supported it, be they political, social, economic, financial, and that includes the banks. I genuinely know that many of you will be disbelieving of the idea that banks could behave in such an egregious way. But our purpose tonight is to show you, quite literally, show you and talk you through precisely how and why that is the case. So that's what we're doing today. That's what we're talking about. I genuinely wish to suggest we show our appreciation to the individuals who have been survivors of financial crime who are speaking out, and of course the individuals who are the blowers who have come forward. I'm going to show you something that I think is going to, I do hope, give you something to relate to. Again, I'm going to just talk it through now. Here's a quotation, forgive me, here's a quotation that I'm going to read out because the typing is quite small. It's Robert F. Kennedy. It's very old, but it's as apt today in 2023 as it was when Robert F. Kennedy said these words. Every time we turn our heads the other way, when we see the law flouted, when we tolerate what we know to be wrong, when we close our eyes and ears to the corrupt because we are too busy or too frightened, when we fail to speak up and speak out, we strike a blow against freedom and decency and justice. And that's why we're here right now, all of us. We want to speak out. We want to tell the truth. We have no fear in doing so because we know we are telling the truth and we can prove it. On that note, I'm going to stop sharing my screen and invite Sir Norman Lamb to spend a few minutes talking about his perspectives on these issues. We know that for many, many years, Sir Norman Lamb has been a wonderful supporter of people who have bravely and courageously spoken out against malpractice by the financial industry. Sir Norman Lamb is a patron of a very, very good charity, Bank Confidential. Various people here today are involved with that. Sir Norman Lamb, I and many others here know you and know your reputation and know what you've been doing. We are very, very grateful for you being with us tonight. And can we please all, first of all, show our appreciation to Sir Norman Lamb for doing what he's done in the past and what he's doing right now. So Norman Lamb, over to you, sir. Thank you very much indeed. Thank you.
Thanks a lot, Andy. I appreciate those kind words. And I should say right at the start that I am not an expert in how financial products work, how they're sold, and the abuses banks may be guilty of. But I did try in my time as a Member of Parliament. I left Parliament at the general election in 2019. I tried to be an assiduous Member of Parliament and to support constituents when I felt that they were subject to appalling wrongdoing. And in my role as a Member of Parliament, I came across my former constituent, Mark Wright, who'd been an employee of the Royal Bank of Scotland. Mark was a brave whistleblower. And Andy, you mentioned that the financial system has to be trusted to function effectively. Well, we also need brave whistleblowers in order to keep any system straight and honest, and to call out wrongdoing when they see it. Mark did that, but instead of being made a hero for what he did, the bank sought to destroy him. And then the FCA rubbed salt into that wound. Their treatment of Mark Wright was, in my view, appalling. And so I felt it was my duty and responsibility to fight on his behalf. I spoke in Parliament about this. I pursued the Financial Conduct Authority. We met with Andrew Bailey in Parliament, but I was left with the very clear sense that we got absolutely nowhere. I felt that there was a conspiracy of silence, and I was struck by the repeated failure of the Financial Conduct Authority to rigorously investigate, or indeed to investigate at all, very serious allegations relating to a state-owned bank, for goodness sake. Now, we know that vast numbers of livelihoods were destroyed. We know, tragically, that people have taken their own lives as a result of the way in which they were destroyed. And we know that banks took inexplicable action against large numbers of people. That is intolerable, it's unacceptable, and it has to be exposed. And I was left, Andy, with the sense that regulators and government ultimately were complicit. They had no interest in opening a can of worms. Indeed, far worse than that, they appeared to have a direct interest in keeping the can firmly closed. And I was left with the big question: was a blind eye turned by government and regulators to allow the banks to rebuild their balance sheets with no great concern about how they did it and who might have been collateral damage? That felt to me like what was going on. Now, we ended up pursuing the issue of swaps credit lines. And I had a real concern, and I still have that concern, that because this is quite complex, because it is technical, it is beyond the understanding of many journalists, I suspect. And so those responsible have hitherto got away with it. I hope very much that tonight might be the start of that changing. And I pay tribute, Andy, to Steve Middleton, a persistent, tenacious and smart campaigner who has uncovered yet another egregious aspect of the scandal that unfolded in this country. The treatment of customers, SMEs, in Northern Ireland and in Ireland, who have been left without compensation, and some of whom have taken their lives in tragic circumstances. We will hear more tonight, but I have been left in no doubt at all that there needs to be a public inquiry. the allegation that is made is one of criminal behaviour of the most serious sort, a conspiracy of those involved, and this must be investigated. Thanks very much indeed, Andy.
So Norman Lamb, thank you very, very much indeed. Can we please do two things, folks? Can we put our hands together for Sir Norman Lamb and also for Ian Tyler, who's going to be our next speaker. So Norman, thank you so much. Thank
Pleasure.
you so much indeed. Thank you. Thank you. Mr. Ian Tyler, please take a moment to introduce yourself and share your thoughts. Ian, if you don't mind, please talk about your background. I really want everybody to understand the kind of roles and background you've had, because it's absolutely wonderful that you have decided to speak out and to talk about your insights around these matters. Folks, Ian is an absolute subject matter expert. If you don't know that already, you shortly will. Ian, thanks for being here. Over to you, sir. Thank you.
I'm a bit reluctant to speak too much about myself because this isn't a job interview, but at the same time, I do understand that just having some idea of my background is helpful. I mean, basically, my main career was as a bank treasurer. I started off in Barclays, and in fact, as long ago as 1990, I put in their first hedging program for the whole of the Barclays Bank UK balance sheet, and that's when I first, got involved with derivatives. So, 30 odd years of using derivatives. Later in my career, I was a small Scottish bank that became a very, very large one, Royal Bank of Scotland Group, and I was the head of the non-traded market risk team, which we had 50 people working for me that were responsible for managing all the market risks on the balance sheet, which includes all the interest rate risk of the balance sheet. And I have been responsible for capital and liquidity and the other balance sheet risks. But the most relevant one to this evening is interest rate risk. And at the same time, since leaving banking, over 10 years ago, I then was a consultant for the likes of Deloitte and then Alvarez and Marsal, selling consultancy back into the financial industry. So I'm still very much in touch with how banks manage this risk. And so I guess I just want to make it clear that I fully understand derivatives and the features thereof. And so how did I get involved in this? Because I was already involved with Transparency Task Force, and Andy and I worked on a couple of things. But in this particular issue, it was Steve that actually got me involved, Steve Middleton. Almost exactly a year ago, he sent me he just literally sent me one facility letter for a customer in Northern Ireland of Ulster Bank. And it literally took me 30 seconds to realize there was something fundamentally wrong with what Ulster Bank had done for that customer. Because on that facility letter, it had set out, here is a fixed rate loan for that customer, fixed rate loan. But in the same facility letter, it was talking about a derivative with a credit line against that derivative. And I'm an expert. The one thing I absolutely know is it's not the customer that needed the derivative, it's the bank that needed the derivative, because the fixed rate loan was the customer's hedge. So the customer didn't need a derivative. So why? So that took me about 1 minute. It then took me another 3 or 4 minutes to work out why on earth was the bank trying to tell the customers something that was patently untrue. And the obvious answer is, the thing you need to understand about why the banks were using these derivatives for customers was they were able to load the derivative. So they were adding like 50 basis points to the swap rate, and that's 50 basis points per year. But the beautiful thing about a derivative is you can fair value it on day one. So you can take all of that profit on day one. But if the bank had done it properly and had actually done the swap itself, they wouldn't be able to book that profit on day one. They would have actually had to accrue it on the loan, because the swap would have, this is a bit technical, but the swap would have consolidated out. It wouldn't have made any difference to the group's P&L. But Ulster didn't want that. Ulster wanted to have that profit on day one, which is why they put the swap against the customer when the customer didn't need the swap, and why they booked the day one liability. And so this is wrong. I mean, this is fraudulent accounting. It's fraudulent everything, because you're misreporting your capital base, and you're breaking all the rules of accounting and regulation, and worse than that, they're also damaging the customers. So immediately I said to Steve, this is worse than mis-selling, this is fraud. And so I produced a short presentation, which I'm going to share with you, and this won't take me long to go through it, but so I'll share screen. Hopefully this will come up. Please let me know if it hasn't come up, but has that come up? Yeah.
Yes.
You can see it, can you?
Yes, we can see it.
Good. So this is I produced this in May of 2022, and the logic being, having spoken to Steve, I said, look, we should try and get the regulators to do something properly, because this is clearly damaged a whole cohort of clients in Northern Ireland, because the facility letters Steve had shown me were in Northern Ireland, but I was absolutely certain that exactly the same arrangement would exist for this cohort of customers in the Republic of Ireland, because the way this had been set up was using the trading desk in Dublin that Ulster Bank had. So I actually sent this originally to the PRA, the Prudential Regulation Authority. The reason I did that is I have a slightly higher opinion of them than I do of the FCA. I thought they might take it and engage with it and actually then help us in dealing with the FCA. I was to be disappointed, but let me just walk you through the slides first. So yeah, the background to this is Ulster Bank Limited had and this is obviously Ulster Bank Limited is the Northern Ireland entity at the time. Ulster Bank Ireland Limited would have been the Republic of Ireland entity, and there would be a similar group of loans in the Republic as well. But these loans had been originated mainly in 2007, 2008. And as I say, uniquely, the customer facility letter stated that the borrower had entered into a swap facility linked to the fixed rate loan and marked an initial credit line. As I hope you already now understand, that is completely unnecessary if a fixed rate loan is sufficient for the customer. And then they had some wonderful wording. And again, this is highly, highly irregular. The facility letter talked about breakage costs arising as a result of the termination by the borrower, either before or after the execution of such an agreement shall be for the account of the borrower. Basically, they were telling the customer he was on the hook for their interest rate swap before he'd even signed his loan agreement, which again, you can't be on the hook legally for something before you've signed it. Highly irregular. And as I say, I've already told you the key fact that unsurprisingly, the bank had this hidden margin on the swaps. That's pretty common for all the derivatives you see for all the banks. They load the margin because the customers are unaware of what the market price is for the derivatives, so they just add another 50 basis points. Effectively, that's like adding another 50 basis points to the cost of the loan without the customer really understanding it. And probably not that relevant to this evening, but some of the facility letters included a poorly worded mark-to-market type charge for early repayment. And actually other loan facility letters didn't mention anything at all about any early charges, which is again a woeful error. As I've said, the main problem is that the customer doesn't need a pay fix swap. It's the bank that need it. To give them a pay fix swap would double the risk, not hedge it. It's the bank that needs the swap to hedge its interest rate risk to its own internal trading desk. And this is why this actually happened. Ulster was quite unusual in being a subsidiary that had its own trading desk. There was no other part of the group, of the Royal Bank of Scotland group at the time, that would have had that. The only other trading desks were effectively in London as part of the major business. And so Ulster was able to do things on a standalone basis. I guess that is part of the reason this actually happened. As I've said to you, the issue for the bank in doing the right thing, i.e. booking an intra-group swap, is that the accounting standards, IS 39, would require the bank to consolidate the swap out to zero. banks had got used to some very dodgy accounting before international accounting standards came along. So prior to 2005, you could have asymmetric accounting on swaps, and and thus banks were able to sometimes front end some income, which was highly dodgy. But now, because they couldn't do it, this was the Ulster Bank solution to the problem, was to tell the customer he did have a derivative, so that what they could do was book the liability against the customer. Because if you book the liability against the customer, you can take the asset through your P&L. And that's the motivation for the bank, to book this large day one profit, so that they can book a profit at the customer's expense from day one. But at the same time as booking the day one liability, the other key feature of a derivative is who knows what the future path of interest rates is going to be, so that the exposure you have on a derivative can go up tomorrow. If interest rates go down, in this case, the exposure would go up from the bank's perspective. So the banks are required by regulation to have something called a potential future exposure, which is essentially an add-on for the possibility of the risk getting bigger. That's a regulatory requirement. They have to hold capital against that. And so the banks deal with that by marking credit lines. Now, the models they use for potential future exposure are now quite sophisticated, quite mathematical. On the whole, the approach to credit lines is a bit more simplistic. They would simply take if it was a 5-year swap, they would simply say it's 10% of the notional or something. It would be that simple approach. But as interest rates came down, it would be 10% would still be added to the exposure. So it got bigger and bigger and bigger as interest rates came down, because that's what happened after 2007, 2008. In response to Lehman's going into administration, interest rates were massively decreased. So these swaps suddenly had very large values. And this was shown up in the example we looked at, again, thanks to Steve's hard work, was that we could see against that customer that initially there had been a credit line marked against the customer of 50,000 on the 28th of January. That's what he was. He didn't know he had that. In a sense, it was fairly hidden. But by the time we got to the 23rd of December, a year and a half later, that credit line was now increased to 267,000. That's treated by the bank as a sort of hard exposure, and thus the bank manages its credit risk on a loan to value basis. And so suddenly, particularly if the property values are beginning to go down a little, and this is going up, suddenly a customer that had a very sound financial position is suddenly in a difficult place. But bear in mind, this wasn't real. This credit facility should never have been marked against the customer. He didn't need the facility. That's why it's a fraud. It's not a mis-selling. It should never have been marked against the customer. And this is why I hoped I would get the PRA involved, because this is a sustained failure by the bank. Ulster Bank Group was effectively at that time, whilst the legal ownership was in Belfast, i.e. Ulster Bank Limited was this parent of Ulster Bank Ireland. In practice, after the first active acquisition, the management was now based in Dublin, and so it was a sustained failure by Ulster Bank Group, by their whole finance, risk, internal audit, even their external auditors. None of them uncovered this accounting fraud. No one spotted it. And to me, it's such a major failure. I would have expected the PRA to be all over it. I think their only defense probably is that this was a number of years ago. But, there are people who were involved with this who are still active in financial services today. Impact on customers. As I've said already, the impact on the customer is to increase the liabilities and credit lines marked against their name. That worsens their LTV, lending covenants, and Steve will go into this in a lot more detail, but obviously it results in many more customers getting pushed into recoveries. One of the few things because I'm an outsider, although I was in RBS at that time, and I wasn't responsible for this from February 2008 onwards, and I left later that year. So I'm an outsider. So I don't have don't have inside information, so I don't know exactly when Ulster Bank discovered this error, or it sort of fezzed up to it. But I'm pretty confident that they knew by 2012, probably caused by any work they were looking to do with customers, because there was at that stage there was this interest rate hedging product remediation exercise going on with the major banks, and Ulster Bank would have been included in that as part of the RBS remediation. However, I believe one of these loans was shown to the FSA, as it was at that time, but Ulster Bank fixed rate loans were excluded on the basis they were fixed rate loans rather than floating rate loans with standalone derivatives. Yeah, as I've said to you already, anybody who's has real understanding of the issues would realize almost immediately that something worse than mis-selling is going on here. So I would argue that there was a major opportunity. The regulator missed a major opportunity to get actively involved in looking at this back as long ago as 2012. It may be earlier, but that is a major opportunity. Ulster Bank clearly did discover their error at some stage. So what did they do? Did they cancel the credit line? Did they do the right thing? Did they cancel the credit line? Did they reverse the liability? Did they send an apology letter to the customer? No. In the example of the customer I was looking at, they simply decided to take a breakage cost of 119,000 and debit it to the loan. Bear in mind, this is a breakage cost on a derivative that I would argue should never have been put against the customer. So they're just debiting the customer with a number that they've made up from an illegal transaction. To me, that is effectively theft. And I'm really, really shocked by it. And I've worked in banks for most of my life, so I don't say that lightly. There was no legal real basis for this charge. And it, it just went on. So I sent this to the PRA, and this last slide is probably less relevant to this audience now, but Steve and I were looking to get some justice for this cohort of customers. We did basically the PRA did look at it, but they declined to take any action, but they did agree to forward it to the FCA for them to look at it, because they said all the issues were really FCA issues. Steve had already independently been rattling the FCA's cage, so the two of us essentially combined at the FCA. We did eventually get to have a meeting with the FCA in late November, and effectively we presented the facts. I did a longer version of this slide deck, and we presented the facts, and we were joined by Prem Seeker at that meeting, which was very helpful. It certainly meant that we got a couple more senior people from the FCA also turned up, because he was in attendance. However, they had the right people in the room. They did have the right people in the room. They asked some good questions, but we're now 5 months, nearly 6 months later, and what has anything happened as a result of that? No, precisely nothing. We sent them follow-up information that they asked for, and despite Steve, and I think I can use the phrase fairly rattling their cage, because he certainly writes a fairly direct email, we've had no response from the FCA. So yeah, essentially, I've loved working in banks most of my career. I believe banks have a really important role to play in the financial system, but this is an absolute outrageous fact pattern, and it's this that actually then has a massive ongoing consequence, because these clients are effectively pushed into recoveries that some of them should never have been in there, and then bad things are done to them, and the whole world is sort of against them, when actually the bankers actually built it on a fraudulent basis. It really is awful. So not very proud of Ulster Bank Group, if I'm honest. Yeah. So that's me finished there, Andy. I hope I kept to my time. Yeah.
You did an amazing job. Absolutely first-class job. That's absolutely fantastic. Thank you very much. Can we please do two things? We're going to be, first of all, showing our appreciation to Ian for what he just talked through, And our next speaker is going to be Steve Middleton. Thank you very much indeed, Ian, and welcome to the stage, so to speak, Steve. Well done, Ian. Absolutely brilliant. After Steve's session, we'll have a bit of a break there. We'll have a bit of Q&A and discussion, okay? We're going to rattle on through and get through Steve's session now. Steve, thank you. Please do introduce yourself, Steve, and over to you. Thank you.
Thanks, Andy. Can you hear me okay?
Perfectly well, Steve. Yeah, great to have you.
Okay.
Thank you.
First of all, thanks to you, Alex, and Chelsea, and all the work you've done to promote this, Andy, and getting this organised and underway. And thanks to Sir Norman for appearing. Appreciate him taking the time out. He was a very, very strong advocate for bank victims and whistleblowers when we worked with him, and I thank him for his kind words. And thank you, Ian, because it's very unusual for a bank executive of Ian's level to put himself, shall we say, on the line to some degree and actually make correct statements about misbehaviours in banks. The majority of people tend to keep their heads down and keep what they know to themselves and walk away and make sure that their pensions are secured. So I very much appreciate Ian, because he's a real expert in this area. And when he tells you that a credit line on a swap or a fixed rate loan is a hard facility, a hardcore facility, that undoes some of the injustices, or starts to, hopefully, that have happened in the courts, where even as recently as in the last 18 months, we've had a case, Perks v RBS, where when a GRG manager, senior director, who also himself was a chartered accountant, was forced to make those admissions under oath, where he admitted that the swap credit lines were real debts, real liabilities, and could push people into loan to value breaches. The first time that had been admitted in court, the bank's barrister, Paul Sinclair QC, or KC now, stood up and said in their closing speech that what Mr. Graham had said was wrong. He was caught on the hoof. He didn't quite understand the question, and these products, these credit lines, could not breach loan to values. Now, that was hearsay. Didn't even say who directed him to state that. That was hearsay evidence. And the judge took that hearsay evidence and based his judgment upon the hearsay rather than the testimony under oath. That is what you're up against in the UK judicial system in trying to get these things exposed. So I'll apologise before I go into it for the wordiness of my slide presentation. I'm not going to go through every single thing I've put on there, but it's a record of information that may be very useful for anybody who's been caught in this situation to go back, look at, and maybe compare their own products or their own treatment. And what we are dealing with is a very, very serious fraud and a very serious cover-up. And there are still people in Ireland today who are fighting to save their homes and their businesses and their assets because of this fraud that remains covered up. So I'll go into my presentation. I'm not very good with IT, and I usually get completely stuck at this point, but I believe this is where I share screen and get my presentation up on the screen. So you just have to bear with me for 1 second while I start this. So slideshow from the beginning. And can you see that, Andy? Yeah.
Yes, we can. Great job. Thank you.
Right. So when is an interest rate swap not a swap? And the RBS systems IT crash, did it relate to Ulster Bank SMEs? Now, there may seem to be two quite spurious points to raise. But as I go through this, you can make your own mind up about what I'm going to say about the IT crash, but I believe it is connected, and there certainly are court cases going through the courts in Belfast at the moment that would say they are. Now, just to start with, just re-emphasising what Ian was talking about, when people take out a swap contract, they're quite simply fixing an interest rate for a period of time, and they will pay the fixed rate to the bank, and the bank will take the variable rate. And what will happen is, if interest rates go down, obviously the bank will make more profit on the variable rate. So if interest rates are, say, 5% and somebody fixes at 5%, the bank is making nothing. If rates go down to 4%, and let's say it's a £10 million loan, and they're paying interest only, the bank will be making £10,000 a year. If it goes down to 3%, they're making £20,000 a year. Now, what then happens is you have a term on the loan. So if, let's say, if that loan was a 10-year term, and the bank are at a position where they're now making £20,000 or £30,000 a year on the loan, they will have a calculation which will suggest what they will make or calculate what they expect to make over the 10-year term. So you might be 9 years in, and the bank initially might have been forecasted it might make £30,000 or £40,000 on this trade, but by the time you're a year or 2 years in and rates have dropped dramatically, it might be 4 or 5 times that or more. So what happens is the bank will actually lend you money when you take out the swap, except they just don't tell you about it. Yeah, and that is margin credit, or what I often refer to as hidden credit lines. So what should happen before anyone takes out an interest rate swap is there should have been a negotiation, and that should have talked about how much initial margin is required. So in other words, if interest rates drop, there's going to be a profit being paid to the bank, and they're going to want some cover for that. So are you going to provide cash? Is there some other kind of collateral? How does it work? And when do you increase that payment if interest rates drop and you earn more? So you normally negotiate something called an ISDA master agreement, and you would negotiate all of these terms. So if you're not putting cash up, are you putting collateral up? What is it? Is it shares? Is it a property? What is agreeable, and what can the other party do with it? Now, it's an FCA rule that if you're selling an investment and that there are risks on that investment, leverage risks like there are with derivatives, then you must describe to the customer the type of risks that are specific to that investment. This is in the FCA's handbook in what's called COBS. It's the Conduct of Business Sourcebook, Rules 14.3. So you have to explain the specific rules, and the descriptions must include where there are margin requirements or similar obligations. So this, in simple terms, is a bit like somebody going into a bookmaker's and doing a spread bet where there's a leveraged win or loss. And effectively, the bookmaker's going to want some kind of cash or account in place to cover those potential losses. It's the same with swaps, but those have to be disclosed. Now, what we had in Ulster Bank, in theory, are fixed rate loans. That's what people were told. Now, the difference between the fixed rate loan and the swap, and Ian's really set out most of that, is that the swap is a standalone trade that's done separate to the loan, whereas in a fixed rate loan, you are fixing the rate as part of the whole loan contract. With a swap, you'd do an ISDA agreement, so it'd be a separate agreement. You wouldn't do that for a fixed rate loan, it's not required. Customer is a direct counterparty to the bank in a swap trade. In a fixed rate loan, they're not. There'll be trades in the background to which they have third party exposure. That's what gives them the fixed rate. Key issue here, in the fixed rate loan, the bank takes the credit risk. So if you fix a loan at 6% and it's for 10 years, your only risk on that, if rates start moving down, is if you need to break the loan. Otherwise, you just pay your 6% per annum, and at the end of the 10 years, that ends. On a swap, however, you carry the credit risk. So you'll be given an initial credit line covering any potential initial forecast losses, and that will also include the commission the banks take. But that can vary massively depending on where interest rates go. So very, very different structure. And this is the first thing Ian picked up when I showed him that loan document. The ongoing risk of rate fluctuation leads to that credit risk for the individual client. You don't have that in the fixed rate loan, as I've said. There are standalone break costs. So you could carry on paying a loan where there's been a swap protecting that loan in theory, but you could break the swap trade. You may have to pay a break cost on it, but it wouldn't break the loan. However, on a fixed rate loan, you simply pay an additional penalty if you break the loan. So a swap is something called a contract for difference. So that's a form of investment, and it's a regulated product. The fixed rate loan, however, is deemed to be a commercial loan. It's not an investment and therefore not a regulated product. But a key thing, and Ian said this previously, and this is a big driver here, on the swap, the bank and the salespeople and the bank managers can all take their profits and commissions up front. Whereas on the fixed rate loan, they'll get a profit over the term. So in spring 2012, because there've been such poor sales standards in the swaps market in those areas, the FCA, or FSA as they were at the time, instigated a pilot review to look at how these products have been sold to smaller businesses and SMEs, consumers. And because over 90% of these products have been missold, they forced 9 banks to undertake a review, and that was called the Interest Rate Hedging Product Review, or IRHP review. So what are fixed rate loans, what are swaps? Back to that same issue. There were 30,000 approximately swap sales between 2001 and 2012. There were 70,000, however, fixed rate loan sales. So a much larger level of fixed rate loan sales as compared to swaps. But when concerns were raised about some of the fixed rate loans creating the same problems or having the same risks as swaps, there were discussions in Parliament, and particularly with the Treasury Select Committee, when they're looking into the competition and lending for smaller businesses. But this is where it starts to get interesting. This is where you start to get very suspicious of the FCA's behaviour, or FSA initially. When they talk about fixed rate loans, there were many victims of a Clydesdale fixed rate loan that were raising concerns with their MPs. So these people faced massive costs to get out of these loan products when rates dropped, and had not been made aware of this. So this was discussed in Parliament and at these TSC sessions. And what the FCA said about these Clydesdale loans, they said Clydesdale sold both standalone IRHPs or swaps and loans with embedded swaps. They then go on to say that these loans are the tailored business loan. That is the brand of Clydesdale. So between 2001 and 2012, they sold just over 8,000 of these. Now, the FCA then went on to say that they didn't believe fixed rate loans were a contract for a difference or a regulated investment because they didn't have a separate ISDA agreement and they didn't have these separate trade and trade credit risks. And what they went on to say in these sessions are, and it's very interesting the wording, they went on to say, tailored business loans are not CFDs. Now, they might be correct in that, but it's interesting wording because they were talking about all fixed rate loans. So why do they mention or only mention the Clydesdale product? So what they literally state, the IRHP review does not extend to TBLs or other loans with embedded swaps or interest rate hedging features, but they very much focus on this TBL or Clydesdale TBL position. So the issue I say that we have there is they are trying to focus all of the attention on fixed rate loans to the Clydesdale product. Now, why is that? Well, I would suggest that one of the issues we have here are the problems with this Ulster Bank loan, because when I sent the product to Ian, I think Ian was bursting slightly because I have told everyone it took him 10 minutes to work this out. And he says it's 4 in total. Well, 1 initially and then a further 3, but I'll let him have that. The loan document itself had these wordings on it. It said that there was going to be swap facility F, which is a £50,000 amount. That's a swap credit line. It says that you're entering into a swap arrangement with a bank, so you're taking a swap out. You're doing it based upon current ISDA agreements, so you're agreeing to do an ISDA master agreement. It tells you the breakage cost shall be for the account of the borrower, but it tells you it'll be for the account of the borrower either before or after the execution of the loan agreement. So it's a separate trade. And then in the advisory note, when these products are sold, the advisory note actually gives you a disclaimer about over-the-counter derivatives. Tells you the fact you're going to be a counterparty and there's going to be a liquidity risk. So if we go back to the comparison between swaps and fixed rate loans, this product ticks all of the swap boxes. It's a standalone trade, or there is one attached, or in theory attached. There should be an ISDA agreement. The customer's a counterparty. The customer has credit risk, and there's an ongoing credit risk. So why were they excluded from the review? Well, people who had these loans when the pilot review started got in touch with the bank on a number of occasions to ask, can we get in the pilot review? These are some of the responses that we have in emails back from the bank. My understanding is that fixed rate loans such as yours do not fall into the remit of the FSA investigation. A further one, any reference to a swap in your documents has only been made in error. The next one, to clarify, you entered into a fixed rate loan agreement in November 2008. This did not constitute a swap. Further one, it is accepted that your previous relationship managers may have referred to this agreement as a swap facility in error. However, your agreement constituted a fixed rate loan. The next one, the references to derivatives on the advisory note is not correct. The wrong disclaimer was used in error. And finally, well, it's not finally, this is just the final example. In regards to the reference of a swap facility within your facility letters, while not being able to reference or discuss any other customer's complaints, I can categorically confirm that you have not been entered into a swap facility by the bank, and any reference to this has been in error. Now, obviously, I got very concerned when I seen that people with these fixed rate loans were not allowed into the review, and looking briefly at the products and everything on the credit files, it seemed to me that they'd face all the same risks that a swap customer had. So I went to the FCA, and I won't read this completely out, but I went to the FCA and said, look, I'm quite concerned here because I believe these people in Ulster Bank effectively had the same products as swaps. So did you take any specialist advice on whether the Ulster Bank products were a swap product? And their response was to me that they'd obtained legal advice on whether fixed rate loan products or similar fell within our regulatory remit, which was not restricted to Ulster Bank. So effectively they're saying, not only did we look at Ulster Bank, we looked at all the other banks. So it's clear that their advisors have studied the bank fixed rate loan, or is it? So I challenged that position because I thought, well, anybody looking at those documents I've looked at and Ian's looked at couldn't possibly come up with that viewpoint. So I challenged it, and the response then came back telling me that they've looked at the information they've given previously, and the FCA's response could have been clearer and may have led to an inaccurate impression. Now, some of us might say they tried to mislead me, and I caught them out. And they tell me then, and honestly state that the FCA did not speak specific advice on the Ulster Bank product. They hadn't looked at it. Now, 70,000 fixed rate loans were sold throughout the United Kingdom between 2001 and 12. Only 8,000 were Clydesdale tailored business loans. What about the other 62,000 contracts? Now, the FCA's opinion on these matters was done by Charles Flint QC, and he, I believed, had based his opinion purely on the Clydesdale tailored business loan. So I went back and asked that question. Was the advice or this opinion that seemed to cover all fixed rate loans based only on the Clydesdale TBL? And if so, when the barrister for the TSC, Jonathan Fisher, went along to look at this analysis or opinion, was his viewpoint on fixed rate loans just based upon that one product as well? Now, this is where the FCA didn't like further questions. So what they said to me, as per points 1 and 3, they relate to advice from counsel. We're unable to disclose this to you. This is our transparent FCA. But they go on further. In respect to this information, claim to legal professional privilege could be maintained in legal proceedings. And for the reasons set out in Annex below, such information is exempt from disclosure under Section 42 of FOIA. So not only are they saying that it's exempt, they're challenging me to say, even if you take us to court, we will not release that opinion or give you that information. So why are they so defensive? Well, that's because I believe that they began back in 2013 and 14 a ruse. And that ruse was to try and suggest that TBLs, or their advice on TBLs covered all fixed rate loans, including Ulster Banks. Now, when I'd said to them back in 2020, I asked them about meeting, which they said at the time they couldn't do, because they said, look, there's an independent review going on by John Swift QC, and that review will consider, amongst other things, whether the criteria for eligibility to benefit from the scheme are appropriate. So it wouldn't be right to comment at present. So they're saying that John Swift's team will deal with all of this. So I went and met with John Swift's team, and I gave them all the documents that I've given to Ian and that I've looked at and other experts. I met with them. I explained all about the margin credit and how it had been covered up on standard swaps and how it wasn't dealt with in the review and the rules weren't complied with in the review. But I went on to explain specifically about the Ulster Bank fixed rate loan, and I gave them all of those documents. What happened? The report came out, and in 493 pages, it didn't mention once the Ulster Bank fixed rate loan issue. What he does do, however, he actually carries on this ruse about TBLs. Yeah, and he actually has a section in the Swift report where he classes all fixed rate loans as tailored business loans. Well, they were. That was only Clydesdale's product. But he actually has the heading tailored business loans. And he said, as discussed at chapter 2, the FCA had concluded the scope of the scheme, that's the IRHP review, should be limited to standalone IRHPs rather than TBLs. So he mistakenly classes 62,000 products as the products sold by Clydesdale. Now, the FCA don't point out this mistake. They won't go on to say to Swift, the legal position is that TBLs are embedded. So again, they're referring to a Clydesdale product to cover all 70,000 fixed rate loans. And they've done that, I believe, since 2013 to rule out all of these other 62,000 products. And why have they done that? Because the TBL products do not have a swap credit line. And by doing this, they've managed to avoid issues like the Ulster Bank fixed rate loan, which, if it was exposed and the fraud around this was exposed, would have blown up the IRHP review in total, I would suggest. Now, part of the reason I say that is if you look at the IRHP review and look at the amounts of products, these are swaps sold in various categories. So category A, the worst type scenario, category B are a fixed rate loan type or vanilla swap, and category C are a car. You can see that the largest bank by far to have sold these products is RBS, our state-owned bank, 9,248. But what happened when they were compensating people, they were also one of the worst banks for providing compensation. Whereas HSBC ripped up 95% of their missed sales or provided a small cap as an alternative, RBS did that in only 56% of occasions. So they were getting out of paying full redress by giving people alternative swaps and other products. So the Ulster Bank risk is huge to, I would suggest, both RBS, the FCA, and to the Treasury. Because if Ulster Bank fixed rate loans had got into the review, which clearly they should have done because they carry swap risks and swap credit facilities, they would all have had to have been torn up because they were based upon a fraud. And because they were sold on this fraudulent basis to get commissions that were not due, then all of the Ulster Bank victims of this scam would have been due consequential losses. So that would have been a huge payout for RBS, but it was also very damaging because the FCA had gone to great lengths with the banks to build a review that didn't mention credit lines. Yeah, because that was the fraud in the background. They didn't want anyone to work out. They were lending people money for loss-making investments and then suggesting they didn't know that would cause damages. Now, how ludicrous is that? If I sell you an investment and I have to put a credit facility in place to cover your expected losses at the same time, how can I then suggest I didn't think it would damage you? So the credit lines had to remain hidden. But if the Ulster Bank fraud had been admitted and would have been exposed, that would have showed the real damage of these credit lines, because people would have been going into GRG and forced into insolvency for facilities and debts that not only did they not know about, but have been put in place through a fraud. This would have opened up the whole of the IRHP review across all the banks to this risk of consequential losses, because it wasn't foreseeable that you were going to create losses for people when you sold those products. So when did RBS find out about this issue with Ulster Bank? Well, as Ian said, we can't know for certain, but certainly at a high level within the bank, someone had to make a decision that these people with fixed rate loans and swap risk were not going to go to the review. Now, it could have been Charles McManus, who was the chief financial officer, or Joe Malloy, head of the Irish GRG. Clearly, someone at senior level were training staff to parrot these words, that any reference to a swap in your documents has only been made in error. Now, we then get into an interesting sequence of events, because in 2012, in May, when the pilot review of the Irish peer review is supposed to be starting, Philip Hampton, who is the chairman of RBS, confirms that Ulster Bank is the group's single biggest headache, and they've had to put 13 billion in there since the crisis to keep them going. Yeah, but interesting at the same time, just as the review is about to start, the Ulster Bank look at trying to, or put forward to the regulator, they want to shut up to 40 branches in Ireland, and it's even mooted that they might be looking to leave Ireland. And the head of Ulster Bank Workers Union even says that usually people go to their foreign regulators because it's easy to scale back operations. And in fact, in July 2012, Bloomberg announced that Ulster Bank had told the Irish government it wants to be regulated by the Bank of England instead of Ireland Central Bank. So just around the time that this fraud is being looked at, I would suggest, and becoming a huge risk to RBS itself and the Treasury, Ulster Bank want to be regulated by the Bank of England, which would mean they are under the auspices of the FCA. So I believe in 2012, the bank would have known about this issue, and I believe the FCA would have known about it. Now, I can't say that these facts add up to anything, or these coincidences, but I know what they suggest to me. You can make your own mind up on this. There is a case in the High Court of Belfast at present that says that the failure of the computer systems at RBS in 2012 was because the bank were trying to put a patch on their system to get rid of these credit lines, because people had been doing DSAR or data subject access requests, getting their files, seeing these credit lines and claiming fraud. Yeah. So if you look at the timeline, in May 2012, Hampton says that Ulster Bank is the biggest problem for RBS. In June 2012, RBS are in discussions about who goes into the Irish peer review and who will be dealt with in the pilot scheme. And there are Ulster Bank fixed rate loan customers asking to be in the pilot. 17th of June 2012, while this is going on, there's a systems update that crashes the Ulster Bank and NatWest systems and part of RBS. Interestingly, 2 days later, two of the people who would probably have known fully about this scam and how there was going to be intention for a cover-up, Charles McManus, the CFO, and Joe Malloy, head of GRG, they both leave around the same time for personal reasons. While the system still crash and the credit line evidence for the fixed rate loans at Ulster Bank clearly can't be seen, an agreement is reached with the FCA on the review and who will go into it. At the same time, in June 2012, there's over 100 technicians, IT technicians, working on the Ulster Bank systems, having to manually rebuild the data on there because of what happened with this failed patch. And as I say, you then get Ulster Bank saying they want to be regulated by the Bank of England or FCA. When the systems come back online, some of these people with fixed rate loans can no longer see their loans on the system. Now, some people were blaming the software programmers back then for the problem, but in July 2012, CA Technologies, who provided the software, confirmed that they'd reassured other customers that the issue with RBS was a specific problem to the Ulster Bank platform. Now, in September 2012, the FCA tell the bank they've got to do a Section 166 and appoint a skilled person. PwC are appointed. In October 2012, RBS are notified that they're going to be called before the Northern Ireland Assembly's Committee for Enterprise, Trade and Investment to discuss the glitch. On the 5th of October 2012, a week before that meeting, the Chief Administration Officer, Ron Teeling, who was responsible for the IT oversight, he suddenly leaves for personal reasons. Around the same time, Tony Stennett, who was directly responsible for the crash systems, leaves for personal reasons. So when they go to the meeting on the October the 12th, there's a Mr. Higgins from RBS who's representing the bank on this matter, who was involved in the investigation, and he confidently states, "We now know the root cause, and we've produced a report for the FSA on this computer crash." But when he's asked to share the broad conclusions from the investigations, he states it's a part of the investigations and I have signed a confidentiality clause with the FSA. And he then refuses to provide any further detail on what caused the glitch. That now leaves the FCA as the only party who could report on the cause of the IT crash. So what happens with PricewaterhouseCoopers? Well, you tell me. I can't find anything in the public domain about when they finished their report, what was reported, or what was found. In fact, if you look at the FCA report, they don't once mention the skilled persons report other than the fact that they'd instructed one. What do they come up with? Well, they actually do admit that there was a patch put on this version of software. So they were updating something called a batch scheduler, and they had a version 1 on, and they'd already tested a version 2 and it was compatible. But for some reason, there was a version 2A. 2A contained a modification known as a patch. They admit this. But that had never been tested for compatibility. So somehow or other, a late amendment to this version 2 has been made, but there's no explanation anywhere in that report as to what that was for. And the FCA conclude that not testing version 2A for compatibility was the cause. But what did RBS Board say? Well, when you look at the Chairman's report in the 2012 accounts, Philip Hampton states, while these failings, and this is directly in relation to the IT failure, while these failures show our continuing need to update our risk and control systems, they at times had a deeper cause. Some employees put their own interests well ahead of customers and shareholders, ignoring the difference between right and wrong. It is a matter of great regret that the conduct and values of a very small number of people fell so far short of what we expect. RBS are stating misconduct and employee wrongdoing is what's to blame. Hardly the statements made to an IT failure. Now, how does that affect customers in real terms? Now, because I'm going on longer than I meant to on this, I'm not going to read right through this, but you should look at this statement here of what happened. This is a Mr. A who took a £770,000 loan out in January 2008, and unbeknownst to him, started with a £50,000 credit line on a swap. He did say that in his loan document, but he didn't understand what that meant. And without his knowledge, that was repeatedly increased as interest rates dropped until it was at 303,000 in March 2009. Now, against a £770,000 loan on what had been a high loan to value borrower, that put him under tremendous pressure on loan to value, and he ended up getting transferred into GRG. When he was put in GRG, they were constantly pushing him to refinance, or threatening him with receivership or insolvency. And in May 2012, just before we have this IT crash, his bank manager behind his back goes to the markets team and asks what it would cost to break his fixed rate loan, which was a 10-year loan. She is told in order for the swap facility to be crystallised, a break cost of 129,000 will be incurred. So she knows that there's a break cost. She knows that there's a swap facility in the background. You then have the IT crash in June 2012. Well, what happens? Well, no payment had ever been missed on the loan up to that point, but you can't make payments in June because the systems are down. They can't do it in July, and they're told not to leave the money because their bank can't allocate it anywhere. When the systems come back up in August, they can't make a payment because the loan's not on the system. Then what happens? His GRG manager, again without his knowledge, goes to the markets team and now breaks the swap that's in his name that he never contracted to. They then take this £119,000 from his loan account without any permission or authorisation. The bank manager puts it in his current account and then transfers it to NatWest Markets to cover a swap break cost. He was never notified of any of these things, only found them later on in his bank statements. At the same time, then, the bank manager then serves a demand for the loan, which is, the loan has never been defaulted, hadn't had a payment missed that they could make, and the demand that the loan and the 119,000 additional amount and interest is all repaid. Just days after he gets the demand, that person then asks if they can get into the swap review or pilot review, and they are told, my understanding is that fixed rate loans such as yours do not fall into the remit of the FSA investigation. So you take that timeline as you will, but you've got people there who've been actively bust at the time the systems are down, and by the time the systems are back up, they're in recovery and facing receivership, when they have that fixed rate loan and credit line issue. Now, again, I won't go right through this, but this is something people need to look at and understand. This is all to do with the fact that in 2009, RBS agreed with the government to get substantial amounts of debt off its books. It targeted developers, builders, real estate, hospitality, leisure, construction, and they created a non-core division for all of these loans. 342 billion of loans that went into the HM Treasury's asset protection scheme. And those loans, what they didn't tell those customers, A, that they were non-core, but B, that not only did they not want to support the businesses anymore, they had an active remit to run them down, bust them, or try and take assets through West Register for their own balance sheets or through other holding arms. The Asset Protection Agency were an arm of HM Treasury who actively made the bankers at times, even when they wanted to support businesses, bust the businesses or take their assets so they could have them for West Register for RBS's own balance sheet. So the issue you have here is that fixed rate loan victims, you can imagine this was all going on in 2009 to 2012, the asset protection scheme. If fixed rate loan victims had got into the review again in 2012 and explained that fraud, imagine how much it would have opened up the can of worms in relation to these thousands of other customers who've been bust. I mean, there were 3 million accounts in the asset protection scheme. And within 3 years, they had run down 280 billion, no, it's 300, roughly 280 billion of those loans. Ulster Bank was virtually all went into the asset protection scheme and into the non-core division, certainly in Northern Ireland. And no doubt that was one of the plans to get rid of the problem or cover up this ongoing fixed rate loan fraud. So if it looks like a duck, it quacks like a duck and it walks like a duck. I think we're all familiar with that statement. In this case, however, the Ulster Bank fixed rate loan victims did have a duck. They did have a swap risks and they had every right to be in that IRHP review, receive protection with their banking facilities and receive compensation. So when is a swap not a swap? It's when the FCA decides to, or is instructed to protect HM Treasury and their behaviour and their risks, that they must tell people that they haven't had one. So the FCA either colluded with RBS or turned a blind eye to this serious fraud in Ulster Bank to protect RBS from compensation risk in Northern Ireland and Ireland and the exposure of margin credit. How was it hidden? 45 million ways to do this. I won't go into detail now, but through 2007, 2012, the FCA had to fine RBS in 2013 because they had misreported 44.8 million trade transactions, such as these derivatives and swaps. They'd also failed to actually register 804,000 trades at all. Now, I would suggest in the middle of that mess, complete mess that covered 40% of their trading books, it would not have been difficult to hide several thousand of these fraudulent swap products in Ireland. The fixed rate loans that we know of all were transferred to Cerberus through Promontory at Iran. It was a 4.8 billion portfolio sold for just 1.1 billion. So that's my allegation, that SMEs in Northern Ireland and the Republic were condemned to insolvency and despair to boost RBS's balance sheet and cover up the fraud in a UK state-owned bank related to those fixed rate loans. And my apologies for taking so long, Andy. I didn't have time to go through this time-wise earlier.
Steve, you have absolutely no reason to apologise. I'm just in absolute awe at the time and effort you would have put into putting that slide deck together and presenting it. And of course, the only way it's possible is because of the mountain of hard-earned experience that you and your associates have managed to bring together over the years. I think everybody's going to want to join me in doing exactly what I'm going to do now, which is to applaud your work, Steve, and everybody else that you're associated with, sir. Thank you very, very much. You're a shining example of standing up, not standing by, You're a remarkably conscientious and highly ethical guy who's not taking the BS that's been thrown at you from all places. And I have complete and utter respect for what you've been doing, Steve. So based on what Steve has shown and what Ian was saying earlier, we're on really safe ground when we say there has been a fraud, a widespread banking fraud. There has been a catastrophic regulatory failure. And there are different types of catastrophic regulatory failures. Some of them were what you could put down to innocent incompetence. In other words, when the regulator gets it horribly wrong, innocent incompetence. We're not talking about innocent incompetence here. We're talking about something far, far, far more sinister and more worrying than that. And it's pretty damn obvious that there's been a cover-up proportional to the size of the regulatory failure and the size of the fraud. Steve Middleton, thank you very, very much indeed from all of us. We're going to check in now just for some comments and questions from others before we go to Chris Gordon and then to Mark Wright. So I'm going to go on gallery view. Please raise your hand digitally if you know how to, or literally if you don't. Just wave at me, okay? I can see we've got Paul Carlier, we've got Norma Henderson, Hubert, and Chris Gordon, who's on the screen as Paul. I'll try to remember those names. So Paul Carlier, Norma Henderson, Hubert, and Chris Gordon. Thanks very much. Paul, to you. Thank you.
Yeah, first of all, echo what Andy just said, Steve. Great piece of work, very diligent and really well presented so that anyone can really understand it, and it will be a very useful record going forward. I mean, I could talk for hours on this, but Andy's told me to be very succinct, so I'm only going to make a couple of points. One of which is that Steve pointed out that he met with Swift's support team, the support team of John Swift, and all of the evidence he gave him was never mentioned in Swift's report. A very similar thing happened to me. I met with John Swift's, I personally approached the investigation. John Swift personally wrote to me and invited me to meet with him. I was a former Lloyds Bank employee, director on the trading floor. I worked on the very trading floor where these swaps were sold and customers were fleeced, and I've made protected disclosures in respect to this kind of conduct. I met with the support team. Before it, I gave them a whole host of evidence that they wouldn't have got from somebody else. The Lloyds Bank pricing policy, the documents given to the skilled persons, which define the scope, which importantly never mentioned margin credit or margin requirement at all. So when Mr. Swift was opining to the TSC that had there been a problem with margin credit, the skilled persons would have raised it. Well, they wouldn't have done because it was completely excluded from the scope of the skilled persons' work on the review of these cases. Having met with Swift's team and given him some smoking gun, really unique evidence, including an undisclosed conflict of interest that led to the infamous crest sign decision and these various internal policies, I then never got the meeting that I was promised with Swift. And thanks to a DSAR to Ashurst last year, about an hour after I left that meeting, somebody sends an email to Swift, which is, and I'm going to say it here, it was little more than a fraudulent misrepresentation of me, my testimony and the evidence, and at the end concludes what the intent was by way of this misrepresentation. And it says, I don't think there'll be any benefit in you recalling him. So I've made the position before that, and I think it happened to Steve, and I think it happened to any others that had testimony or evidence that challenged the desired narratives, we were dishonestly triaged out of the independent investigation. I'll leave it at that, and I've got all the evidence from the DSAR to suggest it and demonstrate it.
Well, thank you very, very much indeed, and I appreciate you being very succinct. Folks, what we're covering tonight is so serious. We're going to be having a follow-up event, probably in about a month's time, and that will be a great opportunity for Paul and others who want to build around what's being covered tonight with further detail. Thank you so much, Paul. We're going to go from Paul Carlier now to Norma, and then to Hubert Armstrong, then to Richard Loxton, and then to Chris Gordon. So Norma, you're next, please. Thank you. You'll need to take yourself off mute, Norma, if you haven't already done so. I think you might be waving at me, Norma. I think you're waving to say you're okay. I think that's what you're saying to me. So we're going to go to Hubert. Hubert, you're next. Thank you. And again, Hubert, you'll need to take yourself off mute.
Okay, how's that?
Perfect. Go for it, sir. As succinctly as you can. Thank you.
I will indeed. First of all, absolutely brilliant listening to Chris. Unbelievable. I've been in this fight now for probably 15 years. I thank you, Andy, for the invite. I thank you for your advice. And indeed, there are other gentlemen on the panel tonight that I have spoken to and I've had assistance from. I know the Ulster Bank very well. I banked with them for over 40 years until Fred Goodwin took over. So I left there, but it was from frying pan into fire. I joined the Northern Bank, which was taken over by Northern Bank of Australia, and then taken over by Danske Bank, and my problems started there. Short time there, absolute total mess. Got myself into a lot of trouble. Having been in business for 40 years and built a reputation personally and a reputation with one of the largest hotel corporations in the world, I ended up with nothing. I know Andrew Bailey. I went to the FCA at the beginning, and I was dumped out of there straight away because my business had been made insolvent by Danske Bank. A nice move by them. Also, I was taken as a case study by the APPG and by my MP, Jim Shannon of Strangford. They put together with Heather Buchanan a fairly sizable document circulated to every MP in Westminster on the 3rd of December 2019. A fairly clear, straightforward document outlining the misdeeds of Danske Bank. I also know a number of folk who are in the same situation with the Ulster Bank, and one of your guests tonight I have spoken to before. The problem is in Northern Ireland, we really don't talk to each other very much because we like to be private and we like to keep things to ourselves. Personally, I'm not one of them. I talk out. I have been in public demonstrations in front of banks with my yellow vests and with placards and postcards and all sorts of things. And I've had meetings with chief executives of banks, and I know that I have been stitched up right, left, and center. And my problem is I go from APPG to the BBRG, and the BBRG is the same nonsense all over again, essentially to keep as many problems away from the main organizations as they possibly can. I'm well known to a number of colleagues in Westminster who have taken my case to the House of Commons and have used our example, and that's recorded in Hansard. I would say that I support without reservation the TTF. I also supported the SME Alliance from the very beginning, who helped me along my way. What I heard tonight about the Ulster Bank is absolutely 100% the same that happened to me, a slightly different variation, but the same thing. Danske cost me 5 to 7 million. They sneaked out of it. We got an arbitration. The arbitration was flawed. There were lies, fraud. I could keep adding to that list. It doesn't really matter. essentially, I'm delighted to be on the panel tonight, not just to blow a trumpet for what I'm doing, and I try to do, and I have been doing for a number of years. I have volumes of evidence against Danske, as indeed I know there are folk there, part of the Ulster Bank debacle, who have equally as much evidence, yet we can't get past the system. I need a champion, as indeed there are those in the Ulster Bank that need a champion. And Chris has done an extraordinary job. And I have to say that Ian, with his knowledge, I just love to have him here for 10 minutes. I do believe that it's people like Ian and Chris, and indeed
Hubert, I'll bring your comments to a close there because we've got quite a bit to squeeze in, but
Yep.
Everybody understands the gist of what you're saying. We really appreciate your comments and your support, and you've been through hell and you're still standing, and that's what counts. Hubert, thank you very
much indeed, Andy.
Thank you very much. We're going to go next to Richard Loxton. Please, Richard, as brief as you can. Then we're going to go to Chris Gordon, then Ian Fraser, then Mark Wright. Richard Loxton, the succinct version of what you want to say. Thank you.
Oh,
You're on mute, Richard, I think.
oh, that's strange because
I think you might have that same, you've got the same microphone probably you had before, Richard. Not to worry, we'll maybe try coming back to you. Let's go to Chris Gordon. Chris.
Hello, can everybody hear me okay?
Perfectly well, sir. Thank you very much.
Okay. Thank you very much for having me on. Based on what's happened the last number of years, I was actually not going to come on and talk about this anymore. However, I've done something that I think is very brief. It won't harm anybody. And that there's, what I'd say is there's a far, far, far bigger story going on around this whole subject. Within 2 minutes of Andy starting the presentation, the Secretary of State for Northern Ireland, Chris Heaton-Harris, announced that he was cutting the budget for Northern Ireland by 10%, and that he had, and the British government had provided £7 billion extra monies to Northern Ireland since 2014, as if Northern Ireland's costing £1.21 for every pound that's spent in England. The reason I'm saying that is that what's not mentioned is that £30 billion was withdrawn from Northern Ireland by Ulster Bank since 2008. All the taxes and businesses and jobs that would have been paying their tax from that point in time have not been paid because of a hidden strategy by the government, the regulators and the banks. And it's important to note that that timing of that announcement was in line when Andy, and you can check this, you can Google this after this meeting, okay? Bank of Scotland, Ireland, I believe, took 12 billion out, and there was probably 100 billion withdrawn from the Northern Irish economy in those key 5 years from 2008. Again, despite the Tomlinson report, despite the large report, despite the FCA summaries, despite the denials in Parliament, despite the inquiries in Parliament, there was actually a hidden plan to put everybody out of business in Northern Ireland from the 1st of October 2008 by the end of 2013. I had 4 versions of what I was going to say tonight. An extremely harmful, detailed description of what's happened here since the 5th of November 2007 in Northern Ireland and Southern Ireland. A less harmful but angry description, toned down with no names, brief description. But what I've learned is that you can't fight this system. They will stop at nothing, and they will resort to all sorts of dirty tactics. So I'm left basically today with this one. It's the least detail as possible, but one that asks those people that are now in power, who weren't in power when the mistakes were made, to act now. You know, and I know they're going to watch this, and I know what really happened. And what really happened should never, ever be repeated again. This is a file with hundreds of emails, screenshots, is the master agreements, £95,000 in swap facility D, screenshots of swap lines opened that weren't disclosed to me, screenshots of the Ulster Bank computer system pre the glitch of 2012. And what I can say is that the last 11-year timeline and what everybody's been told about that glitch is not true. There's basically this file. And this file went into Ulster Bank in the form of a complaint on the 22nd of May 2012. They wrote to me and told me they would reply to the complaint by the 19th of June 2012. Now, in light of what everybody's just heard from Steve, Ian Tyler, and Andy, I want you to bear this in mind, okay? We were all told that we didn't have swaps. We were all told that we didn't have ISDA agreements. We were all told they weren't charging the interest up front. And instead of me getting a complaint response on the 19th of June 2012, their computer systems went down. They went down for a period of 6 weeks until the 3rd of August 2012. Steve, Ian Tyler, people that are watching here that are linked to the thing have seen me for years email different theories, different things across. But today we finally have the proof in that we've got somebody who's an expert for RBS in these things saying that what happened here, and I won't use the word fraud, but what happened here was the huge mis-selling of swaps, the huge mis-selling of ISDA agreements, the taking of the collateral within our properties, the taking of our forward projected interest in one lump sum, and the hidden plans I outlined at the start as being the real reason that the computers had to go down, okay? In that file were not just the screenshots, the emails, and the day-to-day contact. There was the evidence of the LIBOR manipulation. There was the evidence of being distressed for the benefit of West Register. There was the GRG issues as well, which even today, if you look at every press report and summary that's been published and compare them to what I now know and can prove, they weren't true. All these things happened before any loans were sold to Cerberus. The FCA always knew this. The loans were never meant to be sold to Cerberus. That's why the original FCA date for publishing the Section 166 was meant to be the 3rd quarter 2014. If anyone watching this goes and tries to Google that and goes and looks at any official report, you'll find it's missing. It's like they put vanish in the washing machine. After this, go and read, okay? Basically, they say the first time they mention it is 2015. Instead of putting out in the 3rd quarter 2014 a compensation scheme for everybody sold ISDAs, swaps, hidden swaps, forward charging interest, pretending funding was coming when it wasn't, and hiding that they had a strategy to put everybody out of Ireland and out of business. By the end of 13, they published a fake IT glitch report. Steve mentioned it earlier about version 1, a software patch that they hadn't tested called version 2A. Version 2A was an attempt to hide that we were sold regulated swaps. The RBS Section 166 GRG report, which you can't find any mention of anywhere, being the third quarter 2014, was not published. In fact, if you again search, you'll find that it didn't finally get published until the 12th of June 2019. 7 years to the day that Philip Hampton said that Ulster Bank was RBS's biggest headache. Why 7 years is important is that's when public authorities have to legally retain all information. Okay, 12th of June 2012, 1 week before the computers go down, Philip Hampton said Ulster Bank's RBS's biggest headache. Now, based on conservative estimates from Steve and different people, if 4.8 billion pounds worth of loans, which were eventually sold to Promontory Aaron, and if all the people destroyed before that had have got into an IRHP report or review, and if that fake notice hadn't been published, the compensation, if they'd been torn up on the 29th of June 2012, would have extended into the tens of billions of pounds. If you Google it, the government knew that, and they issued a statement before the end of 2012 that they were going to give away the RBS shares for free to the public. When this file went in, it was a simple file. It was a simple knowledge based on chats with people, based on my own emails, but I didn't know what an ISDA was. I didn't know that they took the full value of my properties because they were broke. And we have the minutes that says September 2008 that even with an RBS credit line extended to Ulster Bank, the bank was insolvent. We have those minutes. So the motive in October 2008 for selling us the ISDAs, for selling us the swaps, for selling us the forward charged interest was to make themselves solvent again. And this was exactly the same week that the statement went up for Mark Wright and all the RBS staff to reinvest their monies into RBS because it was safe and secure. So at the same time as this was happening here, the staff themselves were being tricked and conned. Hence why Sir Norman Lamb, Mark Wright, and those people were lied to by the FCA about the existence of the statement that said they were solvent and it was a safe bet to invest their monies into that. The managers that I dealt with, that some of them now are very close to me, and we are, I believe, friends as long as I'm not being set up again. During that 11-year period, I've made multiple reports to different authorities. And today, as I sit here, I have given up. Basically, Steve and different people are far more knowledgeable than me about credit lines and accounting. And if I'm sold a credit line for 95,000, they can raise £1 million with that one credit line alone. The swap lines that were charged up front were described in the paperwork to all the customers that ended up in Promontory Aaron as fixed rate loans where they'd be taking payments every 3 months. In fact, they weren't. That's why it was all booked up front, okay? That evidence and different evidence has been given to the FCA since January 2013. Adair Turner binned the letter and sent it to somebody that deals with like SAR requests. The Ulster Bank computers were changed on the 2nd of March 2013 into computers that no longer showed a lot of these loan accounts as existing. But they were, and the fact that they didn't get into the IRHP review was because the new system didn't show them. So on the 1st of April 2013, the new regulator took over. I was in an extremely scared position, and the computers went down the 28th of March 2013 in what's another glitch. When these glitches happen, these aren't glitches. The phone systems in RBS are connected to their RMP system. They are deleting and wiping evidence of what they've been up to. Last year, the last glitch was the 28th of June 2022. And I have been trying to get the things into court. I've had the managers basically treated the same. I've had every solicitor that I went near up until recently employed, retained by the bank. I've had other things happen, solicitors, I'm not saying on this programme. My point is that I'm trying not to harm anyone within the bank, believe it or not, who I've been in contact with. I'm trying to be respectful as well to the people in the FCA that I went to see in September 2018 and gave them the evidence. I'm trying to be respectful, believe it or not, to Martin Wheatley, because Martin Wheatley called Ross McEwen to the FCA offices on the 8th of May 2015 with the full intention of doing something about this. And again, some of those press reports are missing, but some aren't. At that point in time, they had that evidence that I've just shown you. They had obviously the knowledge as well. George Osborne sacked him. And that was the reason George Osborne sacked Martin Wheatley, was for taking action about something 8 years later is manifesting itself into something bigger as part of a further 8-year cover-up that wouldn't have been had he not been sacked and had the original second section 166 been published in 2015. From 2008 until now, £63 billion has been drained from the all-Ireland economy by this one issue alone. In England, the Perks case judgment said that contingent liability wasn't real. I think that was sort of all the guys that go on, Paul Carlier, Neil Mitchell, Steve Middleton, all the guys that follow this type of thing, have been trying to prove all along, and our lives have all moved on the same journey from 2012. Contingent liability and interest charged up front was real. And that's the thing that they're trying to keep the lid on. So while the loans went into the Asset Protection Agency, and there was terrible, terrible, terrible things done through the Asset Protection Agency, I'm not going to get into the details of what we know and can prove, but that lasted up until last year, the cover-up in regards to that. And I believe there's good people in government, in the Labour Party and the Conservative Party, who had no idea, because of all the denials in previous years, what had really gone on with that agency. But those emails from those poor managers to me saying, do this, do that, pay this, pay that, and you'll get further funding, weren't possible because of those rules. I think that's what's always been hidden. And I'm not naming, but key government officials resigned last year at certain points or were sacked that have tried to keep a lid on this since UKFI was actually the shareholder executive 2008, okay? So all the intellectual knowledge in regards to the Asset Protection Agency was transferred over to the government in December 2012, and it's never since that point been publicly available since. What can I do now? I can't really go into the 11-year timeline, There's things in that are so bad that I don't want to get into it ever again. So I'm not getting into that for very good reasons. But I sit here today. I go to court regularly. I am calm in court. And I go there, and every time I go there, there's still these lists of people being pursued by the bank or Promontoria who aren't aware of what happened in 2012 and who aren't aware of what happened last June. Nobody in this panel is aware of what happened last June, and I hope you never, ever have to hear what really happened. All I'm doing by doing this presentation is saying the people that were sold fixed rate loans here, the IT glitch was about you. It was an attempt to keep you out of the IRHP review. And because they were able to change their computers by the 2nd of March 2012, you still don't know that you had one of these loans that's sitting here today. There's people there in this audience, Paul Carlier, Steve Middleton, Ian Tyler, different people who have the expert knowledge that if you or anyone you know can get your paperwork to them, even if you're bankrupted or about to lose your home, who will be able to tell you today that you have or had a swap. And somebody after this year might be able to help you. But because, yes, a lot of people here are very, very, very private. And again, Andy, I've pulled out on a number of different things that I was meant to attend with you. But I did that because I was being targeted. My family were being targeted. My partners were being targeted. And my family were being targeted digitally, break-ins, nails behind car tires, and crazy things that actually sounds completely crazy, but it's true, it's photographed, and it's logged in different police reports. So all I can do is say, thank you, Ian Tyler. At the RBS AGM this week, or the NatWest AGM, Howard Davies was approached and asked about this very subject. He was approached behind the scenes by Neil Mitchell. And this week, April 27, 2023, nearly 10 years, 10 months after the RBS computers went down because of an IT glitch, to hide that, he told Neil that it was a conspiracy. Exactly the same way Andrew Bailey told Parliament on the 5th of March 2020, it's a conspiracy. Well, if you've got the screenshots of the pre-glitch Ulster Bank computer platform, if you've got the paperwork, if you've got a former RBS accountant on board saying that we all had swaps and if you've got a series of financial experts who regularly post on Twitter saying that these are swaps, and if you've got tapes within the FCA proving that you proved to them that swaps were sold here, all I can say, Mr. Davies, you followed a 9-year timeline until you leave next July of covering this up. You still have time. You've got the opportunity to put things right here, stop repossessions in regards to Promontoria, put a review in place for all the missold ISDA deals and fixed rate loans. Do something good before you end your career, maybe retire or go back to the London School of Economics. So that's my ask of him. And I believe and know that both he and I know that there's a far worse timeline involved in this whole matter. that ran until the 28th of January this year, and events that ran alongside the cover-up, which I'll never ever make public. But this is your chance. Rather than deny, and working through the banker's playbook, is to do something good before you leave, or I know it will follow you in 10 years' time. That's all I really have to say. And again, thanks to everybody that's been involved in this tonight.
Mr. Chris Gordon, I'm virtually speechless, and that's saying something. I'm virtually speechless about the power of your input in your testimony tonight. Chris, thank you so much. Thank you so much. We all feel exactly the same way. Absolutely incredible testimony. My goodness me, we're going to go quickly to Ian Fraser. Ian, to you, sir. Thank you. I'm actually stunned by what I've just heard. Stunned by it. I totally believe it, and I'm stunned by it. Ian, to you, please. Ian Fraser. Thank you.
Hi. Yeah, that was incredible. I just wanted to give a little bit of background to the story of Ulster Bank. It was founded in 1836 in Belfast. It was then bought by Westminster Bank, which was subsequently part of National Westminster in 1917. And then in 2000, Royal Bank of Scotland acquired the whole of Ulster Bank as part of its takeover of NatWest, at which time the assets were 9.2 billion. Fred Goodwin wanted to shake the place up. You know, he was pushing for growth. This was the Celtic Tiger was an interesting, rapidly growing economy at the time. So he wanted someone who would actually drive rapid growth. And he met his man, Cormac McCarthy, who's a former KPMG accountant. And he basically decided that Cormac McCarthy was the guy he wanted to lead Ulster Bank. In order to get him, he paid roughly £620 million to buy the bank that Cormac McCarthy then worked for, which was called First Active, which was a mortgage, a former building society, which was a mortgage bank. So he basically paid £620 million to buy First Active, largely, apparently, because he wanted Cormac to run the enlarged group. So then, you know, there was a very sudden culture change within Ulster Bank, which happened in round about 2003, at the time of the First Active takeover. It went from being a conservative, Protestant stroke unionist outfit under NatWest's ownership into being a much more aggressive lender determined to basically hugely expand its balance sheet and turbocharge its own growth under Cormac McCarthy and Fred Goodwin. Anyway, they embarked on something ridiculous called the Journey to One. So basically a bank which was pretty small, had 11% of the Irish market, wanted to become larger than the biggest Irish banks, which were called Allied Irish Banks and Bank of Ireland, by 2012. So within 8 years, they set on a journey to one to become the biggest bank in Ireland. And the Journey to One project gained like a cult-like status within the group. They were kind of away weekends where people went and stayed in hotels, and they had presentations from people like Bob Geldof, and they had presentations from other key Irish figures who were promoting this Journey to One as a sort of major goal for the entire Ulster Bank group. Older, more experienced staff were effectively purged and replaced with younger, more malleable staff who were more likely to sign up to the J21 idea. Anyway, I won't go, I know time is short, so I'm not going to go on for a huge length of time on this. But what I would say is that, you know, I think inevitably, when a bank has set its sights on a rapid growth as being its sole objective, things like ethics tend to go out the window. Things like proper risk management, things like compliance, they tend to be either sidelined, neglected, or ignored. And the objective of just enlarging the balance sheet and pursuing this ridiculous goal of overtaking the two largest banks within an 8-year period dominates the thinking of the institution. And obviously with things like interest rate swaps and with fixed rate loans, that there's a huge attraction there, particularly with the interest rate swaps, in that they get day one P&L, i.e. all the profit from these products is booked on the day the product is sold, which is attractive to a company which is obsessed with short-term growth and short-term profits growth and short-term financial performance. There's a number of people who were key. There was Paul McDonnell, who was lending money to property developers. There was Robert Gallagher, who joined as head of corporate banking and financial markets in September 2005. Sorry, there's a whole number. There's a Henry Elvin, who joined as head of corporate and property, or who was head of corporate and property. And you know, he was so pleased with the amount of money the bank that was lending, including to the Ballsbridge development under the developer Sean Dunn, that he was bragging about the sums they were lending to property investors, including 500 million pounds worth of finance given to property investors in one financial year, which was 2005 to 6. But things obviously started to go very wrong for the bank. In October 2008, Ulster Bank was part of a rolling series of bailouts that ensured that RBS didn't collapse, and 15 billion of the 45.5 billion that was of capital that was invested by taxpayers in RBS between October 2008 and November 2009 went to Ulster Bank. So basically that is about a third of the total amount of bailout money that was given by taxpayers to Royal Bank of Scotland Group went to Ulster Bank. But the bank, the people who ran the place continued to seem to be totally delusional about the strength of the market and the future of the bank. So even in December 2008, which was 2-3 months after the initial bailout, Henry Elvin was telling the Belfast Telegraph that we remain committed to being the #1 bank in Northern Ireland and to becoming the #1 banking group on the island of Ireland. So the delusion persisted for a few more months, if not years. Cormac McCarthy left eventually in March 2011. But he died sadly at the age of 58 in July 2021. Then we've obviously got a whole series of other developments, including the sale of portfolios of loans to Cerberus, which in itself is hugely questionable. We've also got, as we've discussed, the IT meltdown and the reasons for that. But ultimately now, the renamed NatWest Group has decided that the bank has no future value and is closing it down, as far as I can see, in the Republic of Ireland. It tried to sell it, it couldn't find a buyer, which is understandable given the amount of bad debt that it still had on its balance sheet. And it, even after offloading portfolios to Cerberus, 3 separate portfolios of loans to Cerberus, the bank remained unsellable. So now Alison Rose has decided the best solution is basically to close it down. That's my tuppence halfpenny worth on the story of Ulster Bank.
Ian, thank you so much. You've got a wonderful perspective on all these things. Folks, if you haven't yet read Ian's book, which is all about the sorts of things we're talking about tonight, I really do very, very, very highly recommend it. Ian, thanks for giving us that sort of corporate timeline to help us understand the crazy commercial objectives. And it's always the same way. When an organization thinks all that matters is growth, everything else gets passed aside. Risk management, prudent conduct, corporate governance. It's absolutely right, Ian. And the ridiculous thing, of course, right now, if you don't already know this, folks, is that there's this very strong competitiveness agenda running through the financial system that's going to lead to the same kind of issues that we've been talking about tonight, I'm sure. We're going to port in whilst we also at the same time welcome Mr. Mark Rice. Ian, thank you very much indeed. And Mark, please take yourself off mute and share your few minutes of thoughts, and then I'll start bringing things to a close. Of course, if others want to carry on chatting away, we can do so. Mr. Mark Wright, over to you, sir. Thank you.
Can you hear me okay? Because
Perfectly well. We can hear you and see you, Mark. Great stuff.
Okay, well, if this was a course back in my days working for the RBS group for 25 years, this would be regarded as a graveyard session. So I'm going to keep this very quick. Chris Gordon, you may not have been happy to use the word fraud. I'm happy to use the word fraud with regards to your case in its entirety. Equally, Chris, I want to say on behalf of myself and Steve, we've visited you on a number of occasions now in Ireland, and we thank you for your hospitality. And I admire your bravery and fight, not just for yourself, but for other victims in Ireland. And it is quite comical when we are in Ireland with you, Chris, that every other person we walk past knows you, and you seem to know every single victim down every single street. Really, I'm going to be very quick. I want to apologize on behalf of my former employer, where I worked for 25 years, from 1988, for the pain, the loss of life's work, more tragically for loss of loved ones via suicide. That is fact. I encourage any victims on here in Ireland, when this recording is available, to share and share and share and share. It's well documented on Stormont many years ago about the suicides, and thankfully my daughter was tasked with finding as many church email addresses as she could prior to this event. I also want to state as well, because I was concerned to learn that Mr. Broomhead, having been destroyed in court with what can only be described as probably the worst case of perjury and fake documents to be used to destroy someone. What is really disturbing is that Steve works very closely with, we have 28 whistleblowers inside the RBS group. Now, Alison Rose has had from an RBS whistleblower who is on the payroll at RBS, the Broomhead case is littered with fraud to destroy that customer. So if anybody is watching from NatWest, I'd strongly rule against trying to do any further damage to Mr. Broomhead on that basis. When out in Ireland, what I found with spending time with Chris, that there must be areas where the communities are close, but just speak to one another, share, and just pass this video around. Finally, I just want to say, with regards to Ian Tyler, what an excellent presentation. I had a group chat going here with 5 RBS staff because they didn't want to log in. I think that the signature forgery guy did log in. He was taught signature forgery in his first week's induction at NatWest and RBS commercial at Broadland Business Park in Norwich, which is no longer in use. Everything that Steve stated today is factually 100% correct, backed up by whistleblowers. Steve tends to work it all out, and the staff inside RBS will concur his arguments. Like I say, Ian Tyler, the guys were texting me and saying your knowledge in the area and your expertise is exceptional. And I do hope that the email, though, I sent you 2 documents, which I think was spreadsheets from Fred's right-hand man, stating how Capital One tier ratio can be improved by defaulting working loans, not loans that are under pressure, but literally working loans, to stress them and how quickly it will do. Steve, as always, your knowledge is exceptional. It's a shame that it's taken you 7 years to bang this same drum, probably longer. I feel blessed to have met you and to have you as chief advisor of Bank Confidential. And I just want to state really that without Steve and meeting Steve at the right time, I would have been very much a statistic. So I think we should all keep talking, push this forward, because I do believe that this snowball will turn into an avalanche. Thank you.
Well said, sir. Well said. Absolutely well said, Mark. Thank you very, very, very much indeed. Brilliant. I'm going to go through a few slides to take us somewhere quite specific, and then we're going to, for those that want to stay, let's talk. For those that want to stay, we can talk. So I'm going to share my screen, find my slides. Let me get those ready first. Here we go. Share my screen and find my slides. Here we go. So you remember I mentioned this this quotation before. I'm going to repeat it because to me, the message in this quotation kind of talks specifically to where we are. So every time we turn our heads the other way, when we see the law flouted, when we tolerate what we know to be wrong, when we close our eyes and ears to the corrupt because we are too busy or too frightened, when we fail to speak up and speak out, we strike a blow against freedom and decency and justice. It's very, very true, ladies and gentlemen, that that courage is courageous. Courage is contagious. Courage is contagious. I feel it here. You know, we're giving each other the confidence to stand up rather than stand by and to speak out. As I mentioned earlier, the main aims of this meeting were to share and explain the evidence that shows there has been a widespread banking fraud. There has been a catastrophic regulatory failure. There has been a cover-up. And I want to go on record to say this. Everybody involved in the banking fraud, in the regulatory failure, and in the cover-up should be, they're probably not, but they should be disgusted with themselves. Lives have been ruined. Families have been ruined. Children of stressed out parents have been self-harming. We just heard a gentleman say he could have been a statistic, and we know what that meant. I went to a funeral of a suicide victim a couple of months ago. I don't want to go to another one. The people involved in the skullduggery and the criminality and the shenanigans, call it what you like, you should be ashamed. We're also going to continue to gather the evidence, to continue to engage with the media, to continue to collaborate and build momentum. Operation Trident is an idea that's forming. It's all about building support for a backbench debate in Dublin, Stormont and Westminster. You might have noticed we had the former deputy leader of the Labour Party with us tonight, John McDonnell. He said in the chat he's going to be doing all he can to help, which is absolutely marvellous. There are many, many other parliamentarians that will be doing what they can to help us get to where we want to go. Some further food for thought. Margaret Mead said, "Never doubt that a small group of thoughtful, committed citizens can change the world. Indeed, it's the only thing that ever has." Just because we're small doesn't mean we're weak. We don't have to be weak. Martin Luther King, if you can't fly, then run. If you can't run, then walk. If you can't walk, then crawl. But whatever you do, you have to keep moving forward. I absolutely admire, to the depths of my heart and soul, the tenacity of people like Mark Wright and Steve Middleton and Chris Gordon and others who've been through this shocking, shocking life experience. Alice Walker said, "The most common way people give up their power is by thinking they don't have any." The most common way people give up their power is by thinking they don't have any. We are not powerless, people. We are not powerless. We can make a difference. We have the fortune in living in parliamentary democracies where there are people paid to represent us in government. We're going to work closely with them. We're going to challenge them to do what needs to be done. And we're going to do everything we can to bring about the justice that is overdue and so well deserved. And we're not going to give up. We're not going to go away. We're not going to go away. The hard work has already been done. The evidence, the conclusive evidence has been gathered. I'm going to throw it open. There may be folks who want to share thoughts. So please, for those of you that want to stay, please do so. Of course, if you want to disappear at this point, you're of course very, very welcome to. We will be circulating the chat. We will be circulating the video. Share, exactly like Mark has been saying. Let's get a bit of momentum going, big time here. So what we're going to do is kind of formally close the session now. I'm going to carry on the recording. I'm going to carry on the recording. We'll circulate the whole lot. But if any of you want to carry on staying and chatting, of course, I'd be proud to host that session. So, but from me and the Transparency Task Force, thank you all very, very much for your attendance and your participation. There's a superb Mark Twain quote. I think about it from time to time. The two most important days in a man's life are, number one, the day he's born, and number two, the day he understands why. I believe we're here for a reason, folks. That reason may differ from person to person, but every single human being's life has purpose. And it might well be that for some of us, our purpose is to shine a big bright light on the criminality that's been going on and to drag these people that ought to be brought into account in exactly the way that's been talked about tonight. Let's use the power we've got. We've got loads of it. We just need to find a way of organising it, harnessing it and challenging it. So thank you all very, very, very much indeed for being with me tonight. Thank you. Okay, if you want to say something, then wave something at me, be it a hand, digitally or otherwise. Would anybody like to come in with anything at this point in time? It's not compulsory. I'm going to go back to Mr. Steve Middleton. Steve, could I have any sort of final comments and reflection from you, sir, about what's happened tonight? Thank you very much again, Steve, from all of us. Steve, what are your thoughts?
Yeah, I think excellent session, Andy. I think it's difficult to control these things because there's so much information. I apologise to Ian Fraser for running so late before he came on, because Ian's a great speaker and I always enjoy listening to what he has to say. But again, well done, Chris, for speaking out, because we know what you've gone through for a long period of time. And that when you had the opportunity to take an offer, rather than do that, you tried to stand up for all the rest of the victims, which is an unusual and brave trait. So again, thanks, Andy, for organising all of this. I'd like to think this is something we can grow from here, that this isn't just a one-off and we come out and expose it and try and grab a headline. This is about people still going through this over in Northern Ireland. And it was a very, very egregious behaviour, I believe, by the FCA and the bank to do what they did and ring-fence these people effectively and hang them out to dry. And I think John McDonnell being on and saying what he said is extremely positive. We need to get this in the press. And although we're very focused on this Ulster Bank fixed rate loan issue, this opens up swap credit lines. It opens up the other 62,000 fixed rate loans. Yeah, it opens up false accounting in the banks. It leads you to say, well, if that fraud was committed there, what other frauds happened? It dismisses the statements about GRG having no criminality known about and senior managers not being involved or knowing about criminality. It completely exposes the FCA as having known about this and not just not doing their job, but engaging in an extremely lengthy and expensive cover-up. So I think we've got to take this for all the things that it is, that it could be so much more to many people if we can literally get that chink in the armour that starts opening up proper inquiries into what happened in that bank and the other banks.
Thank you, Steve. Fantastic words. Fantastic words. There's some really good ideas put in the chat. We really do need to make very, very good use of social media. Let's get a real buzz going on. Essentially, what we're saying, folks, is that nothing is enough. The truth has been hidden for too long. It's all going to come out now. It's all going to come out there. Mr. Nigel Cairns, for those of you that don't know, Nigel's a wonderful volunteer within TTF, and he's also a big time bank malpractice, malfeasance, misconduct, mis-selling victim himself. Mr. Nigel Cairns, your thoughts, please. Thank you.
Question for Steve Middleton. just to expand perhaps a little bit on his wider knowledge concerning the other major banks. We heard from Hubert earlier on, who said that his case was almost a carbon copy of what we've heard at Ulster Bank and what have you. And I'm wondering what your views are about attempted or real duplications of a similar type of scheme, maybe at HSBC, Lloyds, and the other major banks. Have you seen evidence that you think? Sorry.
No, I haven't seen the evidence, Nigel, but it's always the same with these things. If somebody works a scam out that works them, you've got to bear in mind that this would have been the traders and the treasury representatives and the desk over there that realised that they had this wonderful scam where if they simply put this derivative in the customer's name rather than the bank's and didn't report it properly, they all earned commissions, yeah? And so do the bank managers. Now, what you tend to find happens in banks is when somebody works a scam out at one bank, they know people in other banks, so they move to another bank and they take the scam with them. So I'm absolutely certain that this will have gone to other banks. And I suspect, I mean, 62,000 other products. I mean, this long-term ruse to call everything tailored business loans because they've got this one opinion on one contract. You know, it's very, very carefully planned, and they only do that for a reason. And that's because they're worried about what will be exposed if there's more investigations into the other products. So I absolutely believe, I don't have the proof, but I absolutely believe there will be instances of this probably at all the other banks.
Yeah, it was a rhetorical question, really, because I'm equally convinced that that's the case.
Nigel, thank you very much indeed. Great point you've made through your question, and Steve, superb response. Folks, wave something at me digitally or otherwise if you want to come in with anything here. Can I drag into the conversation Andy Candy, if you wouldn't mind, Andy? Yours is a voice and a perspective I always like to hear. Many of you may well know Andy. We're going to go to Andy Candy, then to Mr. Charlie Ball. Hi, Charlie. Lovely to see you with us. Andy, if you wouldn't mind, just any off-the-cuff remarks about what you've heard tonight.
Yeah, I'm still recovering, quite honestly. I think I need to lie down in a dark room to really properly recover, and probably some beer. I mean, astonishing presentations by everybody involved. I mean, literally one after the other, absolutely outstanding, detailed, forensic, calm, expert. I mean, you couldn't want for better, and it needs to be in front of a parliamentary or independent inquiry, and certainly in a backbench debate. I was chatting to Steve just briefly to sort of bring another angle into this, but I know there's been questions obviously with regards to the SWIFT review and the involvement of Ashurst in that, and that they appear to have a longer relationship with the FCA than was previously understood. And certainly one of their directors is actually a former head of RBS GRG. And I did a little bit of digging around more into his background earlier today. And it seems that Ashurst appeared to have quite a history of engaging in activities to do with Ulster Bank and the sales of portfolios of these derivatives and distressed loan folios. So there seems to be quite an insidious and long history across all of these organisations where there's clearly a strategic and willful intent to push this through the process. And these individuals keep cropping up again and again and again. And it's not a coincidence. It's the same way as saying the FCA keep making these mistakes and these oversights. Statistically, it's impossible to be that incompetent and negligent. It's a willful, conscious process of deceit from start to finish. And I certainly think in terms of Ashurst shouldn't have been anywhere near the FCA independent SWIFT review. And obviously certain points have been raised tonight by Paul and Steve about how that their contributions were potentially triaged out of that. Well, I think this is going to again go back with everything else to the fact that they've been involved probably from the very beginning through certain individuals. And it's quite shocking ultimately, because that's the level of corruption and the depth of it that you're fighting. Don't know what else more I can say really, but yeah, keep going. Let's get this absolutely exposed and dealt with.
Fantastic thoughts, Andy. Thank you very, very much indeed, sir. I think Charlie Ball wanted to come in. Charlie, please unmute and please introduce yourself, Charlie. Tell everybody a little bit about your background. You're an interesting guy. Thank you.
Yeah, can you hear me all right, Andy?
Yes, we can. Yeah, go for it.
I've only changed cameras 3 times tonight, but that's because I'm in Tenerife. It's a tough life. So yeah, this is why I don't drink. It's just all too depressing. So I'm an accountant by training. My father ran a bank. I was a Barclays whistleblower a number of years ago. Nothing really major. It was around PPI and back office stuff. But I wanted to just prove, to get the word out that the culture hadn't really changed. Then I got involved in the Cyprus banking crisis, became a victim of that. And then I sort of headed into journalism and campaigning. So I've got 2 hats at the moment. Ironically, I'm actually still working in Treasury, but on the corporate side, not on the banking side. And I'm also an independent journalist. Done some work on the BBC during COVID. Did a lot of work for RT, ironically, the Russian channel, because British TV wouldn't expose a lot of the stories that I had. And they were the only channel that allowed me to have freedom of expression. Again, the irony. So I've just sort of been dipping into all these different things. I wanted to say, Andy, I'm sorry I've been so absent the last few months. As you know, I do suffer from periodic depression. I find it all a bit overwhelming and depressing, but I'm in awe of everyone's work individually and collectively on this, and it's clear that you're making huge progress. And I just can't believe even what I've heard this evening. So yeah, it's all pretty terrible. I guess the point I wanted to make, and my frustration over the last few years has been, I slotted in as a journalist quite easily, independently, but my main work is sort of cash and treasury. That's where I earn most of my money. But I found it very easy to get on TV because I'm quite charming and sneaky. But mainly for subjects that really didn't mean anything, and they were really sort of meaningless and inconsequential. Whereas if you get the bigger stories, a lot of the media just either won't touch them, or they're too boring, or the financial crisis is over. But there seems to be a real sort of collective effort to just say, well, anything that happens to do with the financial crisis or banking, we just, draw a line under it and move forward. And obviously, we know now, and we knew then, and a lot of us were saying then, that just doesn't work, because 1, you still have all the victims, 2, the compensation and the problems get larger, and 3, there's no incentive not to do anything like this again. So you may well find that you made a lot of progress and you even get a lot of exposure in the media, but you may well need a change of government for this to really gain traction. But I just hope it's sooner. But thanks to everyone for everything they're doing.
Charlie, thank you. Thank you very much indeed. Well, there's an election not too far away, and we are strategically thinking, how can we influence the manifestos of some of the political parties? How can we make this a real talking point? The question I think all the parties ought to be thinking about is, what do we want our financial regulators to be good at? I think that's an interesting question. What do we want our financial regulators to be good at?
Just over the last 3 weeks, I've got something like £450 in compensation just from Barclays for screwing up some little FX stuff that I've got going. If you can apply that to something larger, that would be progress, wouldn't it? But a lot of the regulation is meaningless regulation, and it's applied to the wrong thing, as we know.
Thanks, Charlie. Thank you very, very much indeed. Would anybody else like to come in? I think Mr. Tyler is back.
Yeah, I'd just like to say one thing. Having listened to the whole evening, I think actually, if we were to present this again, I would actually start with Ian Fraser, because actually I think that is the start. The start is that the culture of Ulster Bank was compromised. It was Fred Goodwin who put the new management team in front, and so Ulster Bank did become a fairly rogue bank, and that is the important context. So that's the first thing. The second thing I'd say is, let's not over-engineer it. What drove the bank to come up with this structure was greed. It was all about taking profits on a day-one basis. That's all about bonus pools and stuff like that. So that it's nothing more than the human desire. Well, if I can take £1 million on that trade today, put it in my bonus pool, at the end of the year, the staff get 50% of that money. I get some of that. we all go home and buy ourselves a Maserati or something. So that's the reason why it happened. And then having, explained the technical side, it's absolutely important that everybody understands that the credit lines are a real issue. And to be honest, if you ask me, the single most shocking thing about this is that the regulator doesn't seem to have ever publicly acknowledged that. That to me is the single most shocking thing. Because at the end of the day, I'm well aware there's been greedy bankers in the past, and that greedy bankers is not a new thing, and we'll have them again in the future, I'm sure. And badly run banks will probably have again. But actually, a regulator that over a dozen years has effectively decided to hide the truth on the core feature of a major banking product, to me that's indefensible. And actually, I think they misled SWIFT and stuff like that. I mean, it's just, the more I think about it, the more I think in that sense there has been a horrific cover-up, actually, because I mean, when SWIFT was talking, it was quite clear he didn't really understand derivatives. He was talking about them as if the downside was the amount of money you'd put in an investment. But the trouble with a derivative is you can lose everything and more, because it's a leverage risk against you. So he didn't really understand derivatives, and that it's an incredible time and time again. And I think the regulator has done this deliberately. There have not been opportunities missed. And that's why we're still talking about it so many years later. Absolutely. And so many innocent people have suffered for so long, and lives have been ruined. It is outrageous, really. Yeah.
Ian, bless you. Thank you so much for being part of the team. You're a very, very important part of the team. And thank you very, very much indeed. Folks, wave something at me if you want to say. Hubert, back to you, sir. Go for it. Take yourself off mute, though, first, Hubert. It works a lot better that way. Take yourself off mute. Go
on. Yeah. Sorry about that. Andy, just a quickie, we were talking about when you get something going again and trying to get a backbench debate going. I would remind anybody that remembers, there was a fairly serious backbench debate back some time ago that was kicked off by Kevin Lake, and my MP, Jim Shannon, spoke on our behalf at length. This recorded on Hansard, and he ripped into my bank quite fiercely. But there's also a lot on record at the APPG that was done by Heather Buchanan and some of her colleagues, and also the APPG that put my case together. It's a fairly substantial document, might be of some use, but I do know that from my brief conversation with Ian Gordon, that it is rife in Northern Ireland. I have been going at this now for a long time, and there's my old friend John Guidi just appeared. And hi, John. I know what he's been through. I tried to stop him from committing suicide one morning. I remember it well, and that's going back a long time. But the bottom line is that as time has gone on, believe it or not, I have an exceptional good friend that used to work for the Ulster Bank, and that fell out with Fred Goodwin, and he and I have been friends for 40 years, and he has been trying to help me see things as a banker, and he has explained to me how things are done from year 21 in the banking system, and that has scared me in many ways. But what I find is I don't have a voice because I've exercised as many channels as I possibly can, but putting it all together, I think someone said, why don't we try a class action? As individuals, we really don't go very far. MPs only take it so far as the next election. And then they fall away, or they lose their seat, or whatever it might be. But Ian has it spot on in every aspect, because all of the things that he has spoken about, and I'm not a banker, I'm not a financier, I was a property developer, and I worked for a very large hospitality company all over the world in their property side, and I enjoyed what I did. And when I owned my own company, it was exceptionally successful. And the bank tried to say that I was an idiot and didn't know what I was doing. But I had proven time and again that I did know what I was doing. But as Ian said, there are that many ways that they could twist things in and out. And I had a very high-powered firm of solicitors acting for the bank. It is unbelievable what they put in print and what eventually came out in print, and what has been proven since then that were nothing but lies and indeed fraud. And I'm not at all afraid to say fraud. And I have been in touch with Copenhagen, and the Times have written for me, the Sunday Mail have written for me, the Belfast Telegraph have written for me. I have two half pages in 3 newspapers. It's all there. And I've done the same as John has done. I have gone out and I have put my yellow vest on. I designed the things and I distributed them from here in Northern Ireland to my friends in Birmingham and indeed in Glasgow. And my situation is not that very much different to an awful lot of the folk that I've been talking to today and talked to in the past. They have been screwed by their banks, and my MP put it as bluntly as that Hubert and Marjorie Armstrong have been screwed by the said bank.
Excuse me, we'll hold it there. I think you've ended on a great summary. People have been screwed by the banks. You've hit the nail on the head again. Thank you very much. I think Steve Middleton's got his hand up, and I think I've got a feeling John Goody wanted to speak. Steve, back to you, sir. Thanks, Hubert. Steve?
You're welcome, and thank you.
John's had his hand up for a while. Andy, been trying to get your attention, so let him go first, and if there's any time left, I'll say something, yeah.
Thanks, Steve. Thank you. John, please take yourself off mute and go for it. Forgive me, I didn't notice you definitely wanted to speak earlier. Take yourself off mute. I think you're on your phones. It's a bit harder to unmute on your phone, but it's not that button. It's that one.
Got it then. I'll be as brief as possible. Thank you, Andy. Thank you, Steve, Mark, everyone, because the penetration of an insight has been remarkable. I just want to say to you that the banking industry has, in the United Kingdom, taken a lead from the Treasury. And there's a commonality about the fraud going on. Clydesdale Bank, National Australia Bank, 2012, transferred from Clydesdale Bank to National Australia Bank, 4,600 customers, all commercial real estate loans, all backed by property assets, probably 75 to 80% all sold fixed rate loans. And then National Australia Bank proceeds to squeeze everyone in that business, and then after 2 years, sells them all to Cerberus. Seems to me that there is a pattern going on. There is the same, it's covering up, it's stealing, it's extorting. And the problem we have, gentlemen, as I see it, is until Parliament forces those who have the power, which is Treasury and everyone surrounding it, to say enough's enough, then we're not going to get the change. Parliamentarians have to stand up and say we must get change. And what they don't realise is Cerberus is stealing from us and robbing the country and making us poorer. And because our banking system is on a platform operated by fraud, and why is it fraud? people mention greed. I would suggest that the bank model is failing, and their way of making money is stealing from people. And, you know, I think everyone needs to look at what's going on in banking and saying, this is actually making our country poorer. And we are piggy in the middle. You know, Hubert Armstrong, me, and thousands of others are suffering. Very quickly, I go to court on Tuesday. I go to the Court of Session. I face the 3 top judges in Scotland. I represent myself to ask them for their permission for me to take my case to the Supreme Court. I wouldn't put a bet on it, chaps. Well, I would. I can tell you they'll refuse, but I'll be able to go directly to the Supreme Court. But thank you again for letting me give you my view on what's happening.
John, good luck, sir. Absolutely. Round of applause for John. He's battling like a Trojan. That's just the word that comes to my mind. John, thank you very, very much indeed. We're going to go to Steve Middleton in a moment. Just before we do, I want everybody to understand this. Steve's been the inspiration for today's event. He's been the energy behind it. He's driven it forward. Thank you so much, Steve. I remember the conversation we had a few months ago about this idea that maybe we could do something to bring attention to the sorts of things that have been discussed tonight. I don't know about you, Steve, but I'm just over the moon about how it's gone tonight. And the commitment is absolutely rock solid. We'll do part 2 of this in about a month's time. Steve, to you, sir. Thank you.
No, I agree, Andy. And as I said, thanks to you and your team for such a great support and promotion. So I think maybe just a round of applause for you and the TTF as well for what the effort you put into getting these things exposed. You know, the amount of times I've approached people over the years to try and expose these things, and you know, I'm either told that I don't know what I'm talking about, or that's not how it works, or you know, leave it alone effectively because there are other things to look at. So the TTF have taken a real interest in some of the most key issues and frauds, and for that I applaud you. John, of course, John I know, and John, I really wish you the best of luck next week. John, of course, is a Clydesdale TBL victim. What I didn't mention earlier, because I didn't want to throw too many things into what I was saying in my presentation, is that the Clydesdale fixed rate loan was a complete fraud. When these guys, they may not have had credit lines, but when they did their fixed rate loans, a trade was booked through London to Europe through Nage. They were just internally setting up these trades, yes, but because they wanted to pass the credit risk on, and they made some errors in how they did it, and I know this because I've dealt with some pretty senior people at Clydesdale who work with me on some cases, because they'd not put a direct credit line in customers' accounts. The managers were later on instructed to devalue clients' assets when considering lending. So I have files from Clydesdale where people with fixed rate loans where they're literally manually striking through the value of properties and knocking 10, 15, 20% off those values before they calculate what they will lend to them, because they hadn't passed on that credit line contingent liability. And I still to this day believe that there was contingent liability sat in Nage in Europe, ring fence for those guys. So I don't say that the fixed rate loans at Clydesdale are not in any way a regulated product. I actually think they're as every bit as dangerous and should be regulated just the same as a swap. In fact, I think they are a swap. So anyway, that's an aside. Yeah,
I don't know if you know.
They were a useful product for the FCA because there was no visible credit line on the credit files. That's the point I was trying to make. With you, but all I would say, Hugh, sorry.
I was just going to say, I don't know if you noticed, but did you see Ian Tyler's reaction to what you just said?
Well, no, I mean, what you just
you can tell me I'm wrong again. Ian, you're going to tell me I'm wrong again.
No, well, no, you're not wrong. But I mean, writing down a loan writing down the asset with no reason, that's just fraudulent behaviour. I
can show you it. Ian, you know, we've had these conversations before, and you've told me no, that's not how it works.
Well, it's not how it should. It's not how it should work.
I'll send you some Clydesdale credit files where you see the bank managers drawn a line through the property value and put a downgraded value next to it. And that's what he's working for.
The funny thing is, if you could actually prove that, that would actually, to some degree, undermine that KC's opinion, because I mean, he has given you the correct answer. The KC's legal opinion is correct because of the accounting. Everything follows the accounting. But what you've just described there says, well, the bank actually didn't believe that. So they were trying to market with a...
Yeah, absolutely.
So actually,
But
you just undermined the KC's
Ian,
opinion.
I've tried to raise all these things for many years, trust me. But the problem is when people don't want to listen to you, or it's not within their interests, and this is the point I was going to make to Hubert, and I'm not being critical of Hubert, but the APPG on fair banking was set up on the swap issues. Guter Bebb was the man who ran it. I tried for years to get Guter Bebb to expose credit lines. He actually, at a meeting in Wales, promised me that he would set a meeting up with the FCA, asked me to send files over to him, which I did, and then reneged on that promise, didn't set a meeting up, and said to me he didn't recall making that statement. Now, Clive May, Clive, you were at the meeting. Did he make that statement to me? And later on denied he'd ever said that to me. Guter Bebb, when I did meetings with him, would not look me in the eyes and would not talk about credit lines. That man got the whip when he finished at the APPG as his prize for making sure that issue was never raised. Wow. Andrew Candy and I tried to get Heather Buchanan and Kevin Hollinrake to get a backbench debate going on the credit lines. Clive and I think, tried to get them to look at the credit lines on his RBS invoice finance products, all with no success. Kevin Hollinrake was on Twitter the other week stating that the BBRS is dealing with credit lines. The BBRS is dealing with nothing. Nothing to do with regulations. It will not look at the credit lines. All I would say for you, but and this is between me and you, but I'm saying it in an open forum here, pick your allies very carefully.
Wow, wow. The plot thickens, as they say. Does anybody else have anything they're itching to say before we wrap today's session up? Wave something at me if you do, digitally or otherwise. We're going to bring it to a close there. It's quite right that we do after Steve's session just then. I don't really know what to say, so I'm just going to talk straight from the heart for a few moments. We're on to something here. You know, we're on to something here. This is not futile. This is not a waste of time. We're not just banging our heads against the wall. And I think the reason is because we are learning how to play to each other's strengths and work as a team, without a doubt. The likes of Steve and Chris Gordon and Ian and Andy Candy and John and all of you, you're all like individual pieces on a jigsaw puzzle, and the collective is one complete picture. That's what you're creating. You're creating a complete picture. And then anybody other than somebody who has the misfortune of being blind will be able to see exactly what's been going on. We'll wrap it up there. Brilliant session. Thank you so much for our speakers. Round of applause for our speakers, please, folks, and we'll wrap it up there. Thank you very, very much indeed. Thank you.
Well done, Andy.